to improve their lives and achieve financial independence. Regrettably, still more harmful consequences appear just over the horizon. Soon, Director Cordray, one man neither elected nor accountable to either the President or Congress, will presume to decide for all low-income Americans whether he will allow them to take out short-term, small-dollar loans. These are the very loans many need to keep their utilities from being cut off suddenly or to keep their car on the road so they can keep their jobs. One man will decide whether he will permit Americans to resolve contract disputes more efficiently outside the courts, or allow the regulatory capture of his bureau by wealthy and litigious trial attorneys. And the director, one man violating the express provisions of the Dodd-Frank Act and using junk science, will continue forcing many consumers to pay more when they finance the purchase of an automobile. Why have so many zealous defenders of the Dodd-Frank Act suddenly turned silent? Now, my problem is not with this one man, but with the insidious belief among Washington elites that low-income Americans cannot be trusted with freedom, cannot be trusted to make good decisions for themselves, so Washington must do it for them. It is insulting, it is degrading, and an affront to social justice. Every American, regardless of which side of the tracks they grew up on, regardless of who their parents are, regardless of how humble their circumstances may be, has the right to shape their own financial destiny. But today, they find themselves at the mercy of an arrogant, overgrown, distant, and unaccountable Washington bureaucracy. Instead of the equal protection offered by the impartial rule of law, they are today dictated to by the arbitrary rule of regulators, and exhibit number one is the CFPB director. I was struck at our last hearing by the Democrat witness's description of the CFPB as Dodd-Frank Act's crown jewel. Herein lies the problem. In America, we don't want crowns because we don't want kings, including a king of consumer financial products. Freedom, opportunity, and choice allow consumers to pursue their dreams and achieve financial independence. If Congress is to protect the fundamental rights and opportunities of all Americans, including low-income Americans, then one essential step we must take is to reform the CFPB. I now yield 4 minutes to the ranking member for an opening statement.
Thank you, Mr. Chairman, and I'm pleased to welcome you back to the committee, Director Cordray. We gathered to discuss the Consumer Financial Protection Bureau's semi-annual report, which reflects your diligent work to protect American consumers and establish clear rules of the road to improve our financial marketplace. Director Cordray, first and foremost, I want to take the time to commend your efforts to return hard-earned money to the families who rightly earned it, specifically with the $11 billion of ill-gotten gains you've returned to 25 million Americans. This is no small feat, and I applaud you for it. Likewise, I want to commend your agency's work to end the sorts of unfair, deceptive, and abusive practices that nearly brought our economy to its knees 7 years ago, and that continue to strip wealth from American families. This includes your work to implement payday rules, free of debt traps, to establish debt collection guidelines that promote honest settlements and block bad actors, and to ensure that borrowers have access to fair, responsible, and sustainable mortgage credit. I also want to commend you on your recent enforcement action against a bank for redlining. I know many people think these type of ugly policies are a thing of the past, but this recent enforcement action demonstrates how badly your agency is needed. As you state in your report, the CFPB has also taken steps to empower the American public, launching consumer resources specifically tailored for college students, older Americans, and people preparing for home ownership, not to mention the nearly 500,000 consumer complaints you have processed through your online portal. It is unfortunate, however, that rather than working to encourage good behavior in our markets and support American consumers, opponents on this committee continue to promote measures to eliminate or weaken the Bureau. They've perpetuated false narratives of an agency that is unaccountable and lacks transparency, despite the record number of times You yourself have made yourself available to Congress and the many checks and balances on the Bureau contained in Dodd-Frank. And they continue to support and amplify industry challenges to the CFPB's constitutionality in court with little or no success. So what we're seeing now that the CFPB has celebrated its 4th birthday is that the dire predictions of the Republicans on this committee have not come true. For example, we've actually seen an increase in the share of mortgages made to African Americans and Hispanic borrowers since your qualified mortgage rule was put in place in 2014, after several years of decline. Data shows that access to consumer credit cards is expanding, even for low FICO score borrowers, at the same time that defaults on credit are declining. And one analyst has noted, for all the talk about the death of free checking, nothing could be further from the truth. These are all important facts that bear repeating. Finally, just last week, we had the Holy Father, Pope Francis, come to a joint session of Congress and deliver an historic address. In his remarks, he encouraged us lawmakers to, quote, keep in mind all of those people who are trapped in a cycle of poverty. Director Cordray, I believe your work and the work of the Bureau lives up to that promise of a better economy, one that serves working people and fulfills the American promise of opportunity. I look forward from hearing your testimony today, and I will yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chair of our Financial Institutions Subcommittee, for 2 minutes.
Thank you, Mr. Chairman. Since its creation 5 years ago, the CFPB has aggressively pursued a rulemaking and enforcement agenda, which has really dramatically changed the consumer marketplace. While prudential banking regulators were widely criticized for falling down on the job in the run-up of the financial crisis, the CFPB has not only consolidated consumer protection laws into one agency, but has dramatically expanded their scope. As a result, it's not only necessary but healthy to have a serious policy discussions about the proper balance and calibration of these new and pending regulations. Today, I look forward to hearing from Director Cordray about 2 forthcoming rulemakings. First, the CFPB has announced plans to move forward with rulemaking that will completely alter offering of short-term, small-dollar products. The rule will entirely disrupt the robust, state-based regulatory framework of this marketplace. In doing so, the Bureau has paid little attention to the existing authority and past legislative actions by states across the country. Additionally, the Bureau has failed to identify alternative products for the segment of customers or consumers who will lose access to credit. This is particularly disappointing given the demonstrated high demand and usage for these products. Second, it is widely expected that the Bureau will move forward to prohibit pre-dispute mandatory arbitration clauses. These clauses are a form of alternative dispute resolution that produce a faster and more cost-effective legal avenue as compared to class action suits for many consumers. I'm concerned that the Bureau will fail to give weight to the pro-consumer features of arbitration agreements, which were outlined in the Bureau's own study. For example, the study demonstrates consumer recovery under arbitration is 166 times greater than under class actions. I look forward to learning more about how the Bureau plans to balance the identifiable benefits of these clauses with their theoretical cost associated with their use. While I know my colleagues and I disagree on certain policy positions and actions of the Bureau, I hope today we can foster a forward-looking dialogue that truly examines how this agency balances consumer protection and access and cost.
Time of the gentleman has expired. The chair now recognizes the gentleman from Connecticut, Mr. Himes, for 1 minute.
Thank you, Mr. Chairman, and thank you, Director, for joining us today. I find myself on either side of the regulatory debate from time to time because I believe that regulation should be there, but that it should be finely and carefully balanced. I find myself puzzled by the incessant attacks on you and on your agency. Look, derivatives, securitizations, margin rules, these things are complicated and difficult to fully understand, but the kinds of predatory and inappropriate behavior that the CFPB has countered over the years are not difficult to understand and not difficult to see. I thank you for the fact that the CFPB has returned $11 billion to 25 million consumers. Director, I thank you for making the obvious point, if you've studied any economics, that there is no such thing as free checking. that there are products that look free, but that get paid for through less transparent and less visible mechanisms. And I thank you, frankly, for the work that your agency is doing in my district. In leafy Fairfield County, a bank of $35 billion in assets stands accused of redlining, something that I would have hoped we would have seen the end of long ago. So know that you've got supporters and friends here in the Congress, and hope that your mission continues in keeping the American people safe. Yield back balance of my time.
Time of the gentleman has expired. Today we welcome the testimony of the Honorable Richard Cordray. Director Cordray has previously testified before this committee, so I believe he needs no further introduction. Director Cordray, without objection, your written statement will be made part of the record. You are now recognized for 5 minutes to give an oral presentation of your testimony. Thank you. I think the microphone needs to be...
Yeah, been a little while since I've been in this room, but I should have remembered that.
We can arrange more appearances.
Thank you, Chairman Hensarling, Ranking Member Waters, and members of the committee. Thank you for the opportunity to testify today about the Consumer Financial Protection Bureau's latest semi-annual report to Congress. To frame it as you did, Mr. Chairman, I'm one person who will not be silent about the work and importance of what I believe the Consumer Bureau to be doing on behalf of the American public and promoting and improving the choices in life for American consumers. This July marks 5 years since the passage of the financial reform law. As you know, Congress created the Bureau in response to the financial crisis with the purpose and sole focus of protecting consumers in the financial marketplace. Through fair rules, consistent oversight, appropriate enforcement of the law, and broad-based consumer engagement, the Consumer Bureau is working to restore people's trust and confidence in the markets they use for everyday financial products and services. As we continue our work, consumer financial markets are showing increasing signs of health. This is very important because, Mr. Chairman, you, in your introduction and other speeches, and others have said the same, that the Bureau is cutting off access to credit for the American public. The facts do not bear that out. For example, the latest HMDA data released by federal agencies last week showed increasing numbers of consumers are taking out home purchase mortgages. In 2014, the first year of our new mortgage rules, mortgage originations for owner-occupied home purchases increased between 4% and 5%. The upward trend appears to have accelerated over the first half of this year. After adjusting for merger activity, the number of lenders that reported having originated mortgages showed an increase in 2014, including for community banks and credit unions. Those are the facts. Other consumer credit markets also show encouraging signs of expanding access to credit. In the first half of this year, over 14 million consumers obtained new auto loans, up 8% over the prior year. For auto loans, this marks a 45% increase since 2011 and a 9-year high since Dodd-Frank took effect. Similarly, 54 million new consumer credit card accounts were opened in the first half of 2015, which is 12% more than in the same period last year and 48% higher than the same period of 2011, just after Dodd-Frank took effect. At the same time, the percentage of loan balances that are seriously delinquent dropped below 4% last quarter for the first time since 2007 and down from 7% 4 years ago, just after Dodd-Frank took effect. Equally heartening is the strength being exhibited by community banks and credit unions. Last quarter, lending by community banks grew by 8.8% compared to the prior year, growing at almost twice the rate of non-community larger banks. Credit union lending grew at an even faster pace, and credit union membership over the past year grew at the fastest rate in over 20 years. These are all positive trends for the consumer financial marketplace, very much aligned with the Bureau's mission, and I hope, based on the facts, we can decide it's time that we could all be friends in this particular space. The Bureau helps consumer financial markets work by making rules more effective, by consistently enforcing those rules, and by empowering consumers to take more control over their economic lives. To date, our enforcement activity, as noted, has resulted in more than $11 billion in relief for over 25 million consumers who had been wronged by violations of the law. We've handled over 700,000 complaints from consumers addressing all manner of financial products and services. Many of these consumers are constituents from each of your states. As with the letters you receive from your constituents, the consumer complaints submitted to the Bureau raise issues of serious concern. Along with our enforcement, supervisory, rulemaking, and market monitoring activity, these complaints and the voices of consumers are important to the Bureau. Our work is focused on ensuring that the markets for all consumer financial products and services are marked by responsible practices that help rather than harm consumers. In the most recent semi-annual report, we describe our efforts to achieve our vital mission. We describe various enforcement actions we took. We worked with the Department of Education to obtain $480 million in debt relief to student loan borrowers who were wronged by Corinthian colleges. We also issued a final rule to reduce burdens on industry by promoting more effective privacy disclosures from financial institutions to their customers. A notice of proposed rulemaking to provide strong new federal consumer protections for prepaid accounts, which currently have none, and a proposal to clarify various provisions of our mortgage servicing rules. We're in the process of developing new rules governing payday, vehicle title, and certain installment loans, and we recently finalized changes to some of our mortgage rules to facilitate even broader mortgage lending by small creditors, including community banks and credit unions, particularly in rural or underserved areas. As a data-driven institution, we published several reports to the reporting period that highlight important topics in consumer finance, such as medical debt, arbitration agreements, reverse mortgages, and consumer perspectives on credit scores and credit reports. In the year to come, we look forward to continuing to fulfill Congress's vision of an agency that's dedicated to cultivating a consumer financial marketplace based on transparency, responsible practice, sound innovation, and excellent customer service, where consumers can be both more prosperous and more free to make choices that improve life for themselves and their families. Thank you for the opportunity to testify today. I look forward to your questions.
Chair now recognizes himself for 5 minutes for questioning. Director Cordray, recently there have been an expose by the American Banker, 3 articles dealing with indirect auto lending over the last 2 weeks. Are you familiar with these articles and have you reviewed them?
I am, yes. I've had a chance to read them at least.
Okay. The American Banker claims it has multiple internal CFPB documents showing that your disparate impact analysis overstates disparities, and in fact, the title of their first article is CFPB Overestimates Potential Discrimination. Documents show. Do such internal documents exist that indicate that the CFPB may be overestimating such racial disparities?
So I don't believe that's an accurate account of what the discussion and careful analysis of this issue has been.
Specifically, is there a document from Patrice Ficklin, Assistant Director of Office of Fair Lending, dated April 2013, where she says, quote, there may be some risk of overestimating disparities. Are you familiar with such a memo?
So I'll try to be persistent in answering your questions. I started to answer the last one, and you cut me off, so I didn't get a chance to finish. Shall I finish?
Well, I don't think you were actually, so you answered the question. You do not agree with that assessment, so now I've moved on to a different question. Are you
that's not what
with
that's not what I
memo?
said, and that's not my answer. So I'll try to answer your questions, but if you're going to cut me off in the middle, it's difficult. So what I will say is there have been robust discussions within the Bureau as to how to approach these methodologies. There's also been robust discussions from outside the Bureau, including from this committee in terms of checking and scrubbing that analysis.
I have a limited amount of time here, so I'm asking a different question now. Are you familiar with the memo that I just indicated from Patrice Ficklin?
I believe that I'm roughly familiar with various memos that I have seen.
Okay.
Yes.
Are there any memos that you're aware of at CFPB that indicate that you are overestimating such racial disparities?
So what I will say again is there have been various efforts and discussions to try to make sure that the estimation is as correct and accurate as possible. There are various methodologies that might cause it to be overestimated, some that might cause it to be underestimated.
Director Cordray, I get to control the time here. So you employ a proxy known as BizG, correct?
I believe that's correct, sir.
Okay. Are you aware of other proxy methods for estimating racial disparities that are more accurate than BizG?
I don't believe that we are trying to find anything other than the most accurate method we can. So there have been different approaches to this over the years.
Okay, so you are unaware of other more accurate proxies?
Accurate's in the eye of the beholder. We're trying to get it right. We're trying to understand what accurate means. But if some people think that a different methodology is better, they would say it's more accurate.
The CFPB is using the most accurate proxy method available, in
We're
your
certainly
opinion.
trying hard to do that, and I believe we are trying to do that, yes.
Okay. Has the Bureau ever evaluated how your proxy method estimates race by comparing it to data where race is actually known? For example, HMDA data. Have you ever performed such an analysis? Are you aware of any such analysis?
That is something that has been a bone of contention from the beginning, both in our discussions and with external parties. There's a desire to compare auto lending to mortgage lending and say they're the same thing. But the pool of borrowers is quite different in the two.
Okay, I understand
and
that,
that's
but
the
are
source of some of the
you
disagreement
aware
about
of any
accuracy.
such analysis that has actual racial characteristics as opposed to purported?
So again, HMDA data can pinpoint all of these
I'm
characteristics
just
of
asking,
individuals.
Mr. Director, are you aware of such an analysis, yes or no?
I believe there have been multiple analyses by many different people of that comparison.
Okay, you considered an invalid analysis, but isn't it true that the CFPB has an analysis showing that its own proxy method has overestimated African Americans by almost 100%?
So again, what you're doing here is mixing apples and oranges, okay? Mortgage borrowers is one set of population. Auto borrowers is a very different set of
They're
population.
either a member
and
of
so
a
the two
racial
are not
minority or
readily
they're not a
comparable.
member. We're comparing actual data to your purported data.
Now, you're also comparing two distinct markets with different universes.
I know, but
it's a tough,
Mr. Director,
tough
you do the
comparison.
same thing when you compare auto lending to the general population. Are you
That's
not?
correct. And both of
Okay,
us
well, I'm
try
glad.
to make that comparison and try to get it right. We may disagree about whether we're getting it right, but we're trying hard to do that.
Has the
That
Bureau
is-
at
that
least
you've hit the
controlled?
nub of the issue,
Is the
though, in
Bureau
some
at least
respects.
controlled for other factors like creditworthiness? Do you control for credit scores?
We attempt to control for all of the variables that have nothing to do with prohibited characteristics such as race
Including
or
credit
ethnicity.
scores.
So, again, it depends on the analysis, and there's different approaches to this, and some people would say certain ones are more accurate than others. We've done our best to try to
Well,
understand
isn't it
all the
true that
thinking in
credit
the...
scores could account for some, if not all, of the disparities that you have observed under current law as deigned by the Supreme Court? Don't we have to look at causation?
Yeah. I don't think that it's fair to say, again, I'm not the biggest expert on this at the Bureau or in the social science field. I don't think it's fair to say that credit scores can explain the disparities. However, that's a relevant point. Creditworthiness in other measures is a relevant point. But again, the nub of the issue, which you've hit upon, Mr. Chairman, is whether it's fair to simply compare mortgage borrowers to auto borrowers and say that they're comparable. We think they're not. That's been a basic difference between us and the Charles River Report, for example.
My time has expired. The chair now recognizes the ranking member.
Thank you very much, Mr. Cordray. I want to thank you and commend you for the settlement that was announced with Hudson City Bank for structuring its businesses so as to avoid majority Black and Hispanic neighborhoods. This is a well-known practice to those of us who pay attention to minority access to credit. And I was very surprised, as Mr. Himes said, that the attempt to go back to redlining. This was very important settlement that you were able to enforce. And unfortunately, it appears that Hudson City didn't consider any of these majority-minority neighborhoods to be a part of their CRA assessment area. And I suppose we're going to have to be on the lookout for other institutions that are going to attempt to do this. But really, today should be a time of celebration. You have done some extraordinary things with this Bureau. And as I look at just a few of them, and you mentioned that you stopped an illegal kickback scheme for marketing services, which resulted in $11.1 million in redress for wronged consumers. You also worked with the Department of Education to obtain $480 million in debt relief to student loan borrowers who were wronged by Corinthian colleges, for-profit chain of colleges that violated the law and has since declared bankruptcy. I want to give you an opportunity to just discuss some of this. I mean, prior to the creation of the Consumer Financial Protection Bureau, consumers literally had little or no protection in this government, and you have moved in ways that have benefited our consumers in such a grand way. Tell us about this 11.1 or Corinthian or what you've done with student loans. Expand on that for us.
Okay. Thank you, Ranking Member Waters. On the Corinthian matter, I will say that I was impressed, surprised, and pleased at the work done by our team, which was some of the most diligent and creative work I have seen during my time at the Consumer Bureau, where they were pressing to get debt relief for students. We had sued Corinthian, and we were in court with them. They had sold a lot of debt out from under the lawsuit, so it couldn't necessarily be reached by the lawsuit itself. And it was a really tremendous amount of work by our folks that were able to ultimately secure $480 million in relief for current and former students. That was one of the most impressive things I've seen during my time at the Bureau. On the marketing service agreements that you mentioned, that matter, which was the $11 million matter, we have found over our experience over the last several years that marketing service agreements carry a great deal of legal risk for the participants that maybe has not been fully recognized by people in the industry. It's very difficult to have such agreements and have them be effectuated and monitor them carefully so that they are compliant with the law. That's been a source of concern for us. That was an enforcement action, a major enforcement action. We continue to look carefully at that problem, and it's something that really needs to be cleaned up, and it's something we'll continue to attend to. On the redlining matter that you just mentioned, I was surprised as well. There is such good and detailed HMDA data out there now that every bank and every lender should know that if they are redlining, it's going to be apparent from the data. And I would have thought that we would have stamped that out a long time ago. We apparently haven't. The Justice Department, who works with us on these matters, has indicated that they have more matters open on the issue. So we will see where that goes. But obviously, nobody here, nobody on either side of the aisle, nobody in this room believes that people should be deprived of access to mortgages and other credit simply because they live in areas that have a high concentration of minority residents. That's un-American, it's not right. And we'll continue to, wherever we see that, to work at that problem very hard. And I know everybody in this room agrees on that.
I want to thank you so much for that. I was in the state legislature when redlining was absolutely something that was being done all over this country. And I thought we had worked in ways that would wipe that out, but to see it coming back means that not only are we going to have to catch those who are doing it, what can we do to try and prevent it from happening? What can we do as public policy makers?
I think the deterrent effect of an action like this is very important. I like to think and hope it will prove to be an aberration, but we'll see. The data is very good on this, and it's something we can monitor carefully, and we are very attentive to the problem, maybe more so than it might have been true in the past, for all I know.
Well, I want to thank you. And on Corinthian, we've been working to try and get rid of Corinthian for years. They've been ripping off our students who were looking for just an opportunity to learn and to get a job. And we finally got them, and there are a lot more out there like them. And I thank you for your work.
Time of the gentlelady has expired. Chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chair. Director Cordray, Section 1028 of Dodd-Frank grants the CFPB authority to conduct a study of pre-dispute arbitration. Depending on your findings of the study, the Bureau may prohibit or limit the use of arbitration through rulemaking, or it may choose not to act. I think in March, the Bureau finalized its study, and in testimony before the Senate Banking Committee in July, I think you stated the Bureau would move forward with the rulemaking process. I'd like to get into the kind of the nitty-gritty of this issue with you a little bit. The statute says that the findings of the report must lead to a conclusion that it would be in the public interest or protect consumers to move forward with a rule. But your report found that customers who prevailed in arbitration recovered on an average of $5,300 compared to $32.35 obtained by the average class action member in class action settlements. Can you walk me through how prohibiting arbitration is better when you look at those kinds of numbers?
Yes, I like to try to make eye contact when we're talking back and forth. On the arbitration issue, it is, as you said, it in our statute. First of all, what's notable is, first of all, in the Military Lending Act in 2007, Congress enacted a statute there to protect service members that said there should be no enforced pre-dispute arbitration in any financial service contracts to military service members active duty. That was the first sort of walk back in this area. In the Dodd-Frank Act itself, Congress outlawed pre-dispute enforced arbitration agreements in mortgages. Then they further said, as you correctly and accurately framed it, that on all other consumer financial products and services, they mandated that the Bureau would conduct a study, which we tried to do in very careful, thorough way. It took us several years to gather the data, put it together, and its analysis that even its critics have said is the most comprehensive treatment of this issue they've ever seen, and very complimentary about the approach to it, even though they may disagree with some of the conclusions, and I take it perhaps you do as well. Once we had finished the study, we were to report that to Congress, which we did earlier this year, and then we were to try to make judgments from that report about whether we should adopt regulations affecting those clauses in any way.
Now,
That's something we're now moving forward with.
But in Section 1028, there was not a mandate that you do that. It was Congress gave you the authority to study and to come up with your own determination.
Yeah, it was a mandate for us to diagnose the problem and an authorization for us to act on that diagnosis.
Now,
that's fair.
Your study looked at 562 class action cases, and 92% of those class action arbitration was not even a factor, and this presented no barrier to moving into a class action suit. So can you explain how your study supports the position that arbitration is a barrier to class action suits?
So I hate to try to boil down, the conclusions of a pretty exhaustive study into just a couple sentences or several, but essentially what we found was that the arbitrations were rarely pursued by individual consumers because the nature of consumer financial issues and concerns is that there's often very little money at stake for the individual, although in the aggregate for the financial institution there may be a great deal of profit to be had from a particular practice. And what we found was we did a close comparison of class action suits that such as exist in the area, many of which have been cut off by these arbitration agreements, but some of them still exist, and arbitrations. And we found that in terms of preventing and cleaning up violations of law and getting redress to consumers, you could compare for yourself the numbers, you could draw your own conclusions. We're now going to be trying to move forward and figure out what's the appropriate rulemaking answer to that. And that's a process that will
One of the things
unfold.
that the Bureau has committed to is a pretty aggressive educational process of educating consumers on the choices that they have. I was wondering what kind of resources that the Bureau has dedicated to educating consumers about, arbitration and the pros and cons of arbitration. Have you done any education in that direction?
Well, I would actually say that the first question is what kind of education has industry done who have enforced these clauses over the years to encourage people to pursue individual arbitrations. I don't know that there's been any educational effort by them over decades. So as to what we have done over the last several years, first of all, we wouldn't have engaged on some aggressive education program during a period in which we were studying the problem and trying to diagnose it. We obviously needed to try to understand it first. And again, we took several years to gather data, put it together. Even the critics of the study have recognized this is the most comprehensive, fullest treatment they've seen, and it breaks new ground. Now, having accomplished that, we will go through a rulemaking process where it will be open, notice and comment. Lots of people will have points of view, I'm clear on that, and we'll have a chance to process all of that. That's how we'll try to proceed.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Director Cordray, I would like to thank you for your response to our letter regarding implementation of Section 1071 of the Dodd-Frank Act. As you know, 1071 requires banks and lenders to collect and report credit application data on small businesses as well as minority and women-owned businesses. Can you please elaborate on some of the groundwork you've done to prepare for the rulemaking on Section 1071?
Yes, I can, and I've appreciated I've gotten quite a bit of input on this issue, in particular over the last number of months from members of Congress and also from community groups around the country. What we have always said here is This is an undertaking that, under the Dodd-Frank Act, was placed with the Consumer Bureau. It's a somewhat unusual undertaking because it involves small business lending, not consumer lending, and otherwise have very little authority over small business lending. We do have a little window of authority under the Equal Credit Opportunity Act, and we have indicated we're going to begin some examinations of institutions on their small business lending within the next year. We also said we had another job that Congress gave us to do, a mandatory job, which is to overhaul the Home Mortgage Disclosure Act rules, and to, secondly, take on another job of bringing over from the Federal Reserve the operational, technological aspects of gathering that data, collecting it, and being able to make it accessible to people, which will allow us to update the technology and make that information better, cleaner, and easier for everyone to use, so that when the ranking member asked me about the redlining case, everyone will be able to see the data and diagnose it for themselves. That's good transparency that will help make sure that we can enforce and monitor these types of things. As we are completing that rulemaking, which I expect to be completed before the end of the calendar year, we have then always said that we can move forward with the 1071, that's a section of the Dodd-Frank Act, small business lending project, which is intended, it requires us now to adopt a rule and then figure out all the technical and operational details of gathering data on small business lending, akin to how we've done it for mortgage lending. So having done as much work as we've done on the HMDA project, both operationally and then rulemaking, we can now turn to the small business lending and work on the rule. I think it will take some time. We're going to be reaching out to the Small Business Administration, people at the state level, any of you who are interested in trying to understand how we would do a new data collection for small business lending, how to try to minimize the burdens of that, but how to accomplish the benefits of it.
Thank you. As a follow-up to my last question, we have heard critics of Section 1071 saying that the cost will outweigh any benefits the data collected will provide. In light of this recent enforcement action against Hudson City Savings Bank for discriminatory redlining practices against Black and Hispanic neighborhoods, I would agree the benefits of Section 1071 to minority small business borrowers will justify any monetary cost to the financial sector. Would you agree with that?
Yeah, it's obviously something very hard to judge at the outset of a project, but I will say that I've heard from a number of groups who've spoken powerfully and eloquently to this. What they have said to me is, for the average middle class and working class family, people trying to rise, and it's true of many communities of color, their wealth building happens to occur through home ownership, which was devastated by the financial crisis, by the way, and through small business creation. That's often a big engine of growth and economic development for new families in this country and for communities of color who are otherwise maybe shut out of other traditional networks. So for those reasons, the small business lending seems to me to go hand in hand with the mortgage lending data collection, and it seems to me to be a very powerful way for us to try to understand how we can create more economic opportunity in communities of color and for minorities around this country. That makes a great deal of sense to me.
Thank you. And last, I would like to mention to you, or yes, to make a comment regarding the fact that American citizens of Puerto Rico that invest in mutual funds are not covered by the Investment Company Act of 1940. This leaves them without the safeguards that those on the mainland have. And do you think this is fair?
I don't know that I know enough to answer that question. I'm sorry. I'd be glad to go back and have our folks look at it. And
I introduced legislation to close this loophole, H.R. 3670, and I would like for you to take a look into this issue that is really disrupting the lives of Puerto Ricans, American citizens. Thank you.
Okay.
Time of the gentlelady has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, Chairman of the Capital Markets Subcommittee.
I thank the chairman, thanks the director for being here. I might just take a little different tack on this. You talked about the mandate you had on the mortgage in that area. Okay, good. You know, my dad always said, give credit where credit is due. You've talked a lot already here about what you're doing in the auto industry, in the lending area. Those are the initial questions and some of your focus on, and you're nodding your head, some of the focus of what you're doing and some of the cases that are out there as far as what you've been able to recover for the claimed discrimination and that sort of thing that went on there. Why that is puzzling, though, to me is I was on the Dodd-Frank's conference committee, and I was one that carried the amendment that said that there would be an exclusion for activity within the jurisdiction of the CFPB dealing with the auto industry. And this is one that Chairman Frank accepted, and it was passed in a bipartisan manner, and it passed out of the House and the Senate and signed into law to exclude that area of authority for you to do. And yet, you're nodding your head that you are proud of all the work you have done in that area. And so that puzzles me. So one of my questions is, it's been reported in that same article that the CFPB has been considering how to eliminate dealer reserves. So first question along that line, is that something that you are doing, despite the fact that we've carved out that exception there? Is that something you're doing, yes or no?
So I don't really speak in terms of having pride in this or that.
Okay, but is that,
we're trying to do the work that Congress gave us.
Is that something you've done? Is that something you're doing, trying to eliminate dealer reserves?
So I would start with, you said that the exception said that we have no
something that
jurisdiction
you are
over the
doing?
auto industry.
Here's
That's not the way it's worded.
Director, I only have 3 minutes left. Let's run down the questions. The question is, are you working to eliminate dealer reserves? Yes or no?
We have been working to try to address a practice that we believe is
So
discriminatory
that's a
of
yes.
discretionary
Is
markup.
that a yes, please?
Well,
Let's answer the question, yes or
Not
no.
necessarily eliminate. We had an enforcement action yesterday in which it would limit dealer reserve, but not eliminate it. And we think that may be a fair way to try to address the issue.
So there was a
and we're working
memo
with the
back
industry on that.
So the answer is yes, you're doing that. And there's a memo back in May of 13 says the purpose of a meeting I have is to continue our discussion about a market tipping settlement that would resolve the discriminatory disparities caused by auto dealers by markup, by eliminating markup at major auto lenders. So is that something that you are working on as well?
So what we found is it's a somewhat more complex problem than maybe we thought at first. It's, live and
So
learn.
the answer to that question is yes.
No. So the answer is, we started out thinking that the right answer to that concern
Is that a
about
general
discriminate-
area that you're looking into? Is that a general area that you're looking into? The answer is yes.
Yes, I was trying to be more specific.
I don't have time for more specific. I'm just, are you looking into it?
Yes, we are.
What is the authority for you to do so?
Okay? We have authority in the statute. It doesn't exempt the auto industry. It exempts auto dealers. It does not exempt auto lenders. We have a responsibility to address auto lenders. We understand we're exempt from dealing with auto dealers.
What did you just say? It exempts the auto industry?
It does not. That's what you said in your opening.
So it exempts the auto dealers?
It exempts auto dealers, but it gives us
who are the ones-
responsibility over auto lenders.
So who are the ones in the front line that are actually making these loans? Isn't it the auto dealers?
Look, Congress drew the statute. I didn't draw it. I have to live with it. It exempts auto dealers, but gives us responsibility over auto lenders. I'm not sure that makes a lot of sense, but we're trying our best to observe the lines that
But when you
Congress
make
drew.
these decisions, you're directly affecting the auto dealers. It's the auto dealer that I just went to in order to buy a car and not buy a car, right? And it's the auto dealer that people will be paying the interest rates that are affected by your actions, right?
The
And
loan
so-
is made by an auto lender, and the auto lender controls their auto lending program. They decide whether they're going to deal through dealers or on their own or whatever they do. We have a responsibility over auto lenders. It's a funny provision in the statute. I'm not sure it's very logical, but it's what we have to live
Let's see what the
with.
practical consequences are, and the studies have shown this to be true. By your actions, the interest rates that somebody who goes to an auto dealer, because that's where I go to buy a car, is an auto dealer, are actually going up because of the actions you're taking. Isn't that correct? Isn't that what some of the reports have shown?
So let's make an analogy to the mortgage industry. You might have gone to a real estate broker.
We're on auto here. We're not talking about mortgage.
Okay,
The
but-
results of your actions are raising the cost of buying cars. It's making the interest rates go up. That's what the studies have shown, correct?
What I would say is this. As we do our work, and we have a responsibility
I
to
understand
control
that, but
auto
is
lenders,
the result
it does
of your-
affect auto dealers. I would agree with you on that.
Is the
That's
result
why
of-
the logical provision is not very logical.
Is the results of your action that it's costing more for people to buy cars now? Is that what the CFPB bottom line is? Because the results of one study...
There's disagreement about that, okay? But if you're engaged in potential discrimination in a market, and you cure that discrimination, and that discrimination has been cross-subsidized by the favored groups, then it may affect prices
that are
for the
most
favored
hurt
groups.
by this are the very same people that you claim to help, the people that the poor and the middle class, or the people are actually paying the higher rates. Isn't that true, sir?
No, that's not true.
That's what the studies seem to show.
No,
but
it's not what
I
it
yield
seems
back.
to show. If you're
Time of the
cross-subsidizing
gentleman,
discrimination...
time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Mr. Caudry, there's a lot of discussion as to whether your successor should be an individual or a commission. And obviously, an individual is more efficient, makes decisions quicker. But when we have that efficiency, that means that your successor will be appointed by whoever the next president is, and then the next successor will be whoever, and we could swing very efficiently and extremely from the forces of light to the forces of darkness, and then back to the forces of light, which of course will make it pretty complex to transact business. Let's imagine, God forbid, that your successor is your evil twin, just as capable as you, but determined to undo every good thing that you have done or are about to do. How efficiently could that person, one person running your agency, replace all of the regulations that you'll have enforced by January of 2017 with new regulations that would be touted as good consumer protection, but would in fact eliminate the lion's share of the good that you plan to do in this your first term? How efficient could your evil twin be in undoing everything you will do, have done or will do between now and January 2017?
So it's theoretically possible, but it's not so easy to do. Once you've passed rules and regulations through a notice and comment process, and they are protective of consumers, and those start to become the lay of the land, and institutions adjust to them, even though you might decide, oh, I'm going to undo all of those, it's a whole process to go through. You have to fight the opposition on that. You have to fight whatever evidence there is of how
I would point out the opposition that you face is the industry. In this case, the industry would be on the, not that somebody moving in the other direction would face less opposition than you have faced.
No, they might well face considerable opposition from the American public. And
they might, if the American
country.
public understood the details. As I said, I'm positing that these replacement regulations would be billed as a major increase in consumer protection. But obviously, it'd be more efficient for your evil twin to do this if it was one person rather than a commission made up of both Democrats and Republicans, some of whom agreed with you, some of whom who didn't. I want to move on to another.
Could I respond briefly to that?
No, because I got to move on to the next question.
Okay, fine.
You can respond for the record. Tila Respa, TRID. If you're building a new ship, you want some extra time to get the ship done. But no matter how long you spend at the dock, you're really not done until you take it on a shakedown cruise. October 3rd begins the shakedown cruise, the chance to actually try out these regulations and see how they work. And it's going to be difficult. Now, you've given additional time for the ship to be built, but it still hasn't been on a shakedown cruise. And in fact, you can't use the new regulations for September transactions. But we're closing in on October 3rd. Are you willing to announce a formal, temporary 3-month hold, harmless period for those who are making a good faith effort to comply with the 1,800 pages of regulations and are acting in good faith, knowing that they have never used them before, although they've had enough time, they've had plenty of time at the dry dock?
Actually, all of this area was changed and overhauled in 2010 by HUD. Congress then legislated it be changed again by us. I'm not sure that's the way you would have drawn it up if you'd started from scratch, but they got through it in 2010. You know, it's obviously a lot of angst around it, and people are trying hard to make their systems work. We did give more time, as you said. You and I have had a chance to have back and forth on this a number of times. I've never quite fully understood your phrase, shakedown cruise, but I think I've got the gist of it.
A shakedown cruise is when you go out, you try to sail the ship the best you can, but you don't get sued if the facilities don't work.
So the nub of this, which I think is your biggest concern, is we have said, and we're working now to provide written guidance on this, and we're working with the other agencies so that we all provide the same written guidance on this, that for some period of months, we're not going to be very specific about it, it might be longer, right? There will be a diagnostic approach to this that is not, nobody believes that the market participants here are going to be trying to abuse consumers here. They're just going to be trying to change their systems and get it right. So it would be diagnostic and corrective, not punitive, and there will be time for them to work to get it right and not have to be perfect on the first day.
Will you
Not to
announce
worry.
something by October 3rd?
I'm pushing hard to see to it that it's out before October 3rd. I was hoping it was going to be out before today. But it is going to happen, and it's going to be along the lines of what you have asked for, and I think it will be satisfactory.
I look forward to reading
Time
it.
of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. And just follow up on the gentleman from California's remarks there.
Yep.
Mr. Corder, you and I have had some discussions with regards to TRID and my concerns about it, and I committed to you that I was going to send a letter to all associations, represented people, or industry folks who made mortgages, and to let us know whenever there were some sort of punitive actions that were out of line that was taken by your agency. And I want to let you know that letter goes out Thursday. So just to put you on notice that we're going to be watching.
No, that's great. I'm actually glad to have you monitor this because it's my intention. This is how we handled the first set of mortgage rules, and I haven't heard of any problems, and we're now 21 months in. But I'm glad to have you monitor it because I want what you want is to make sure this is what actually happens. So I appreciate that.
If you live up to your end of the bargain, this will all go away and we'll all live happily ever after.
Okay,
Thank
fair
you.
enough.
With regards to, I want to follow up just for a second with regards to the gentleman from New Jersey's remarks with regards to the relationship between the auto dealer and the lender. I think you just mentioned a minute ago you came out the last few days with a recommendation to have a 1.5% spread between what the lender and the dealer have in their relationship. Is that correct?
Well, there's a consent order that was entered yesterday
Right.
that would have a 1.25%
1.25%,
differential
okay.
for certain loans and 1% differential for other
Right.
loans, depending on time frame.
It's very concerning to me. Number one, where's the authority to do that? And number two, why are you getting in the middle of the general competitiveness of the marketplace?
Why am I getting in the middle of what?
Yeah, it looks like you're price fixing to me. Why are you getting in the middle of a discussion between two entities that determine the risk of the loan between the two? Interest rates should be reflective of risk. It always has been. I'm old enough to remember when we had usury rates. And a few years ago, we took them off. And now, with this action, it looks like we're putting them back in place because you're limiting the amount that people can make based, and you're taking all the other risk factors out, which that's the definition of interest.
Okay, so this is not just a general philosophical thing that we're deciding to do because we have some ideology on this. This is a result of an enforcement action, an investigation by us and the Justice Department. We're not solo on this. We're working with the Justice Department. They have much more lengthy experience in these matters than us. An investigation of potential discrimination, and there was a back and forth with that entity and various other entities, been a number of them, in which it was determined that this was a reasonable result to address the problem and yet to allow the entity to move forward and continue to lend aggressively to customers. And as I said in my outset, auto lending is at some of its highest levels ever right
but
now.
that's
This
because
is
of-
not
that's
interfering
because-
with
Mr.
that.
Director, that's because the economy's come back and people can finally afford to have an automobile in their garage. Let me move on. It seems to me along that same line here, though, that a while ago you said that you're data-driven institution. That's what CFPB is.
We try to be that,
Yet,
yes.
I know in talking with one of my bankers last night, I called him and said, "Hey, listen, tell me what's going on with you and your this disparate impact situation." And he's very concerned because whenever he was examined, basically the examiners looked at three things: loan to value, debt to income, and FICO score. And he was cited by the examiner for inappropriate loans. And he had an outside accounting firm come in, and they came up with two things, the reason he had this problem. Number one, he loaned to people outside the state. And number two, he loaned to very small auto dealers. If they take those two things out, he would have been in perfect compliance. Yet, if that happens, now we're going to restrict the amount of dollars that are available. You're going to lessen the competition. And in talking with him, he made the comment a while ago that there's plenty of access to credit out there. I can tell you that there's a number of banks already that have quit doing this and are looking to quit doing this. And when that happens, there's less bidding going on for those dealer loans. And that means the rates will go up. So,
Could you help me a little bit? Is that a big banker or a small banker?
yeah, it's a mid-sized bank.
Okay. Over 10 billion in assets? Okay, all right. I'd love to hear more. I'd like to know more.
Well, I'd be glad to fill you in. I've got 46 seconds
Okay,
left. But it's
sure.
concerning to me, and I think, I think that you need to be willing to look at other factors when you're modeling this and take those into account, because I don't think that's happening, and I think that's where a lot of problems begin. Just one more quick comment. I also had an entity who was a debt buyer that came into my office recently, and they were fined for a word in their settlement agreement that you're proposing a rule down in the future for. That made no sense to me.
I've heard that, and it doesn't make sense to me either. I don't really understand how we fine somebody for a word. I'd love to hear more and understand that problem. When we investigated, again, I'm not sure which one it is, we've taken several actions against debt buyers who have engaged in some pretty predatory practices, and when we get into the details of it, you wouldn't find them very appetizing either.
They were fined for a word that was going to be non-compliant in the future with one of your rulings, and as a result,
Give us a chance to talk with your staff and understand that problem and see if we can clear that up. I'd love to do that. Okay.
Time of the gentleman has expired. The chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. First, I want to thank you, Mr. Cordray, for your leadership at the CFPB, because clearly over the last 4 years, recovering approximately $11 billion in relief for over 25 million American consumers, that's tremendous. And the CFPB clearly is changing some of the most egregious behaviors from bad actors in our financial markets and helping consumers every day. And your leadership has been to that very same effort. And I think that you have a difficult job. The job is difficult because at the same time you are helping consumers, and then others, you try to figure out that balance to make sure that people still have access to credit and they're not left out. And so there's been this conversation that we've had going on a long time, and I come from my experience, especially when you deal with the short-term loans or payday loans or whatever. How do you balance that? How do you make sure that people have access to credit but are not being ripped off? I mean, for example, I think you came out with a report saying we've got to get rid of these rollovers, the folks that can't afford them, and that gives them a, but at the same time, from my background, knowing what I've seen, I want to put out a business, the loan sharks, in the neighborhood that I grew up in. When banks turned folks down, there was harm done to folks because they had no other choice to go to some of these loan sharks. So the question of harm and how do you, because I think to get rid of the bad of individuals, I don't want to throw the baby out with the bathwater, but I want to make sure that we can keep, because I found some to be good business folks, but others to be bad. You indicated that you were going to be looking at some of the state regulations and how they handle to get rid of the good and the bad, et cetera. So I was wondering if you could give us the benefit of your knowledge and whether or not you think you've gotten enough information from looking at some of the states as to how to properly, maybe we can regulate this, because I'm for regulating this industry, not necessarily getting rid of it, but having some firm regulation, because folks are going to try to find a way to get some money.
Yeah. Look, I appreciate what you've just done is you put yourself in our shoes and recognized in a very eloquent way, better than I would have done, what the two sides of the problem are. You want to have access to responsible credit for people that doesn't get them into more trouble and sink them in these debt traps, but you also don't want people to have to be in credit that is going to destroy their lives. And there's some really ugly kinds of credit out there that we have seen that are quite predatory. How do you balance that? Is not easy. Now, you're from the state of New York. The state of New York bans payday lending because the usury cap is on in New York, and it doesn't really exist. And yet, I take it your constituents are managing somehow or other, and it's true of 13 states across the country. States handle this in very different ways. We've been very carefully going to school on what the states do and the different approaches and what seems to be working in some respects or not working in other respects. And we want to be respectful of that. But at the same time, we've done two pretty comprehensive white papers showing that in this industry, a significant number of consumers end up in a debt trap where they get a loan at a very high cost and they can't repay it and they have to roll it and roll it and roll it. And a large number of consumers end up in cycles of 8, 10, 12 loans. That's very destructive of their economic well-being. Now, can we find some reasonable restrictions here that would allow access to credit and maybe a number of repeat loans, but without people getting so far into it that, I have an example from a court opinion in Missouri. The person took out a $100 loan, And by the end of the whole thing, they had repaid several $1,000s, and they owed several thousand more, and it was all being garnished directly from their paycheck. That's not helping their economic situation. A $100 loan. These are some of the things that we're grappling with and trying to understand, but it is not an easy problem. I mean, the way you framed it is exactly right. We're trying to balance two things here, and it's not easy to strike the balance. We're working hard at it. We're trying to get there.
Thank you. And
Not everybody will agree, I'm sure.
And I'd love to continue to work, and as you look at some of the states, et cetera, I mean, because, for example, what happens in New York, what I'm finding there is a black market.
And
folks are
internet
right.
too, which is...
And they're getting money in that regards, and I see them going, and I'd rather have something that was strongly regulated that they could go to, and then I'd have more confidence that no one ends up with the broken arms or the black eyes that I see some folks ended up with. So I'd appreciate your continued work on that. I thought I'd have more time. I didn't realize talking about that, I'm going to give you the chance to ask to be more specific about the auto loans that you didn't have the opportunity to do earlier.
Okay.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of the Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman, and I'm going to try and go quick. The dealer reserves, I just want to revisit that a little bit and make sure, give you an opportunity to clarify briefly on this. My colleague from New Jersey brought up his amendment, and it's my understanding that neither one of us were here when Dodd-Frank was created, but we're living with the echo effect of it here.
We're both blameless.
The intent of the exemption was the entire transaction, is my understanding. Is that your understanding as well?
I don't have that understanding. I don't know one way or the other about that. What I know is, as I read the statute, we have jurisdiction over auto lenders. We have
Perfect.
responsibility there. We don't have jurisdiction over auto dealers.
Got it.
and we're
All right.
supposed
Will
to
you
keep hands up.
support then expanding or clarifying the exemption to both dealers and lenders?
If you asked me what direction it would go, I mean, I'm not, I try to be very careful to not step in the shoes of you legislators. You have to make those judgments, and I don't have that authority.
Okay.
There's been
well,
a
you
suggestion to go
support
that
and oppose a
direction.
lot of other things.
There's been a suggestion to go that direction. There's been a suggestion to go the opposite direction, and there's a
All right.
suggestion to leave it alone.
All right. Have you issued guidance on appropriate levels then of what a dealer reserve should be?
Guidance.
Have you told people, here's what we think is the acceptable level?
Well, we've had several enforcement actions. We have some
That's
supervisory
different than
actions.
outlining. I know I saw what happened with Ally,
Yeah.
and you have 80 million that you haven't been able to distribute so far, right?
Well, no, that's one thing, but we've had several enforcement actions involving other auto lenders as well, where this has come into better focus, and it's gravitating toward what I said
So
about yesterday's action.
Why not get
limiting
specific?
caps.
Why not get specific then and what that level is?
I think our consent orders now are quite specific, and they have signaled to the industry a possible way for us to resolve this on a global basis, and I think that would be a good thing.
I want to move on real quickly to another thing. Marketing services agreements. And you and I had this conversation last time you were in.
Yeah.
And I'll ask the same question. Have you issued specific guidance on MSAs?
We have gotten increasing input asking us to do that.
Why have you not?
No, we're working on it. We're working on it. Yeah.
Why not just ban them or outlaw them?
Well, what I have said is that what we have seen, and we've had several enforcement actions, there's huge risk involved in those agreements, and people don't seem to have realized it. So, we are going to try to signal, based on our experience, what we have seen, and I think people will get the message.
Let me ask a question, just quickly going back on this Ally situation. You've got $80 million. You've asked people to self-identify as to whether they're a minority and may even qualify. Will you give Ally a refund of the money that's not claimed? Because there's a lot of people that believe that you overextended. You're getting 18 million already in general, and this 80 million is supposed to be distributed. What happens to that money if it's not distributed?
So I understand. We're in process in this, but we're quite confident from what we've seen so far, the response rate, all the money will be distributed. If it isn't, it will not go back to Ally. That would reward them for not getting money out. It would be disgorged to the Treasury.
It's actually you not proving that there was discrimination, or DOJ not proving that.
Not necessarily.
On both, it seems to me, on dealer reserves and the MSAs and a number of other things, it seems to me that you're not willing to issue that guidance because you quite possibly don't have the legal authority to do that.
No, we're working on it. I believe we will issue guidance shortly, and people have asked us very much for that.
The American banker in this story on September 24, I'm going to read this opening statement, the paragraph. The consumer CFPB, the Bureau, has struggled internally on how to end potential discrimination in auto lending. I would add MSAs and other things, including debating whether it should cite a large lender in the hope of effectively ending the ability of partnering dealers to mark up loans to all lenders. And what I'm afraid of, Director, is, and last time you were here in March 3, we were talking about the press release situation. And you had said that the ombudsman for the Bureau is looking into whether there have been differences in the language on the consent orders and the press releases on the actions given. And it seems to me that that is still the case. I'm afraid that it seems your goal is to intimidate businesses, big and small, into actions or inaction that you think it needs to have because you don't have the legal authority to execute those things.
I understand you may think that. I don't think that's true. It's certainly not how I intend to operate. The Ombudsman did look at the issue of the press releases and consent decrees and found that there really weren't any significant problems there. And on this, on the MSAs and on auto...
Could you share that report with us? Could you share that report with me specifically? Because I would like to see that.
I'm sure we can. It may even be posted on our website. For all I know, the Ombudsman has a fair amount of independence from me, but did look at that. On both auto and MSAs, the auto, we have consent decrees in place that do give very specific guidance based on specific facts of situations. On an MSAs, you and others have really pushed us to give more guidance on that. We're going to be doing that. We're working on it right now.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Capuano.
Thank you, Mr. Chairman. Thank you, Mr. Cordray. I've been reading through your report, and I don't know, it doesn't seem like you've been too busy to me. It kind of strikes me as though you're not doing much. From what I see, you've done one proposed policy statement, one final policy statement, 4 requests for information, 13 proposed rules, 11 final rules, 5 bulletins, 2 guidances, 20 orders, 5 assessments of state attorney general actions, which of course is not yours, you're just looking over what the state attorney general does. You've appeared before Congress 5 times yourself, your staff 2 more times. I know that that's very easy. It takes no preparation, no time. I get that. You've done 37 public speeches in front of different groups that are interested in everything you do. Your staff has done 4 more speeches. You've had 14 executive actions taken against different companies, and you've issued 63 reports and financial reports during the last calendar year. It doesn't strike me as though you've been too busy. It strikes me as you're probably just sitting around not protecting consumers and everything else. At least that's what it sounds like today. But then again, you know, the bulk of what you do is only part of it. Apparently, as I read this, you're allowed to spend up to $619 million, but you only spent $302 million. You only spent 48% of what you were allowed to spend. I don't think there'll be another agency in the entire federal government or any state government or any city government, for that matter, that would do that and have the results that you've had. And on top of that, you've collected $47 million in fines against companies that have bilked consumers, and you distributed $113 million to different victims across this country. Sounds to me like maybe you are actually doing something to fulfill the title of the agency, Consumer Financial Protection. Mr. Cordray, I'm here to say thank you. I'm here to congratulate you and your team for doing a great job. Doesn't mean I don't want to nitpick certain things. Of course we do. I know you do that internally, and to be perfectly honest, I think you've been pretty receptive to our comments and to our suggestions along the way on different rules and regulations. Yeah. You've worked with us. Doesn't mean I agree with everything you've done. It just means I think this country's a lot better off with the CFPB than without you, and I wanted to say thank you for that. I do want to ask you, do you think you have any ability or any regulatory authority to maybe take a look at the reactions, or not the reaction, but on the effect on consumers of different federal agencies, most notably the FHA and maybe Fannie and Freddie? Do you think that might be within your purview or outside of your purview?
I don't think it's within our purview to, for example, try to enforce the law against other agencies. I do think it's within our purview and really would be irresponsible if we didn't to collaborate and coordinate and cooperate with the other agencies and try to work toward common policies, which we do try to do with each of the ones you mentioned and many more. So that is something that takes a fair amount of time and effort. And they're pretty receptive, and we try to be pretty receptive, because the worst thing that could happen to an institution is to have different agencies coming at them with contradictory positions, because then the institution, how do you treat that institution fairly in that
Let me
circumstance?
encourage you to work as cooperatively and forcefully as you can with both of them, because both of them, in my opinion, are participating in what I consider to be the slow and steady destruction of various neighborhoods around this country by selling these bulk mortgages to companies that then make a profit, not just a profit, a massive profit. The largest one is the Lone Star Funds, run by a gentleman who voluntarily gave up his United States citizenship. I'll repeat that. We have made a billionaire out of a person who voluntarily gave up his United States citizenship. This Congress spends an awful lot of time debating how we can allow more people to come to this country. I don't know anybody who wants to leave except for the person who is currently in charge of the largest fund, slowly destroying various neighborhoods across this country, because Fannie and Freddie and the FHA refuse to allow local communities to have a say in what to do with houses that have been lost because people couldn't afford to keep them. And I would dare say that if you talk about consumer protection, what they have done, not directly, but indirectly by allowing these companies to do this, I think certainly should fall into your purview. And if not directly into your purview, based on the job you've done to protect consumers, I would strongly suggest you get on the phone and talk to them, educate them, enlighten them as to how we help individuals as opposed to the people who are not even United States citizens out of their own volition. And with that, I'll yield back the rest of my time because I don't really have any questions, just to say thank you again.
Time of the gentleman, he has yielded back. The chair now recognizes the gentleman from New Mexico, Mr. Pierce.
Thank you, Mr. Chairman. Thanks for being here, Mr. Cordray. The question came from Mr. Heising about the money going back, and I understand not a penny has been given back to the people who are discriminated against.
Were we talking about the Ally matter
The Ally,
specifically?
on the Ally, the 80.
Because we've had many discrimination matters, and there's a lot of money going back to
Money has not gone
consumers.
back or has gone back. That's all, a simple question.
All right, so there have been many matters where consumers receive money back. The Ally is a somewhat complicated process, but it's being worked through,
But nobody's received money. So
that is
Patrice-
correct at the moment, but
Patrice
they will.
Ficklin
And they will receive
wrote-
all of it, I believe.
Yeah, Patrice Ficklin wrote on her webpage or your webpage that in December of 2013, we're starting to pay back some of those things already, and it just doesn't seem very believable.
No, it just
Now,
takes
you
time.
said in response, and by the way, if you're not giving that money back, is that racist on your part that these consumers have been defrauded and you've got the money and you've had it in your hand? Is your action not racist?
No, no. We are giving the money back. It's a
just hasn't
process
gone
that's
yet.
somewhat complicated, but it will
It's
get
very
there.
complicated. It's not complicated to cheat them up front, but it's complicated for you.
Well, I could just throw money out there. Nobody would be happy about that. We're
I
going through a
understand.
careful process, and it will get
just
there.
to put this in perspective, the assertions in the Wall Street Journal is that the consumers are being defrauded of about $200 to $300 over the life of the loan. Is that more or less correct?
I'm sorry, what are we talking
Wall
about?
Street Journal says that the differences in interest could amount to $200 or $300 over the life of the loan.
Is it the Ally matter or generally, or what?
Generally, in auto finance,
Okay,
you might have that.
That, depending on the facts, could be about
Which
right.
ends up at 60 months, which Mr. Williams told me that that's what the general financing is for, is $5 a month, 16 cents a day at the high end. At the low end, is $3 a month. Now, consider that compared to, and I've not, in my 11 years, have never had one person come up and say we're being cheated, discriminated against in auto loans. But I have had multitudes of people come up and say in our student loans, they're charging us an exorbitant interest rates. 8.7% is the one that came up to our office most recently, $60,000. 8.5, 8.7% interest, which is a huge amount more. But you all, according to the memos, the internal memos, are redirecting your enforcement away from these high-priced educational problems into the auto industry. That was an internal memo that is circulated. Another memo says that we're not sure that we have the legal authority for doing what we're doing at all, and that the rule could be perceived as an attempt to circumvent the law and our lack of authority. Now, you had told Mr. Garrett that you didn't really agree with the law. Is that something that I heard, or maybe I didn't hear?
Didn't agree with the law?
The law that said you can't go after the auto dealers, but you can go after the financial part of it. So you do agree with the law?
Look,
You said it was
my job is to enforce the law, whether I agree or disagree with it. What I disagreed with was characterization that the auto industry had been exempted from Dodd-Frank. That's not what the statute says, and that's not my understanding of the authority we're supposed to exercise.
So auto dealers are not exempt, or the auto industry, which?
Auto dealers are exempt under the statute. The auto industry is
Okay.
not exempt, and auto lenders in particular are within our responsibility, and we have a responsibility.
So you are attempting to go after you're attempting to go after the dealer markup, is that right? You're trying to assess that. That's the whole 1%, 1.25%. You're trying to determine that.
What I would say is we're assessing lender programs where they authorize discretionary dealer markup with financial incentives to mark up the rate, none of which is known to the consumer, which is part of the reason they don't complain about it. They don't realize that the buy rate was 4% and they're being offered 5.5. They don't know that.
Consumers
It's
who
not
do
transparent
realize
to
they
them.
got a problem in the student loan industry, who complain a lot, they're okay.
No,
Because
we're working
redirect-
hard on student loans. I mean, the whole Corinthian
No,
matter that
you're
got
saying that
$480
the
million.
memo is incorrect, that you're not redirecting resources?
We allocate resources all the time, but the notion that we're not addressing student loan harms when we had almost a
Seems
$500
like a
million
complicated
resolution.
concept of billiards to avoid the law. We're going to hit this ball over here, and it's going to hit that bank, and it's going to come over here, and it's going to tap the auto dealers, and that's who we're really after, because they're the ones
We've been
out there.
very careful to observe that line. As I said, it's not a particularly logical line, but we've been very careful. We didn't even talk to dealers
Like I
for
said,
2
it's a
years until they
complex
started
game
to
of
want to talk
billiards
to
that you're
us.
playing, and maybe that's the reason some on our side have disagreements with the yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Texas, Mr. Hinojosa.
Thank you, Chairman Henserling, and Ranking Member Waters for holding this important hearing. And thank you, Director Cordray, for your appearance here today and for your steadfast leadership at the Consumer Financial Protection Bureau. I'm going to go directly to questions and skip the other points that I wanted to make. Our nation faces a severe student loan crisis. Student loan debt now stands at $1.2 trillion and tops out credit card debt, auto loan debt, and home equity debt. And moreover, default rates on student loans keep rising every year. Can you tell us more about efforts at the CFPB to provide student loan relief?
Sure, and there's been a lot of different efforts, and this is an area where we don't really act alone. We try to work with others, including states, state attorneys general and others, the U.S. Department of Education. We've worked with the U.S. Department of Treasury on these issues. And there's a whole variety of things that we've tried to do. Number one, we've tried to make it clearer and easier for consumers themselves to make their own judgments about what's the right answer for them in a particular set of circumstances. That's our paying for college tool. This is one of the ways in which, as the chairman would put it, we're trying to help consumers become more free. Is if they can make more informed choices, they can make choices that are the best ones in their view for themselves and not have regrets later. We hear plenty of regrets from people who didn't have that kind of transparency around student loans in the past. Second, student loan servicers, the people who actually are handling the debt that's already owed, and there's $1.2 trillion owed in this country, so it's a very significant concern for many millions of Americans. We feel that there are various practices in that industry that are subpar, very much like mortgage servicing practices have been very subpar for a long time. And so we're looking at trying to figure out how we can work to sort of clean that up and bring that up to a standard so that people who already owe a fair amount of money to get an education, that's burden enough, aren't further burdened with misappropriation of payments or payments that go to the lower interest and keep the higher interest, and various ways in which this industry is not serving their interests well. Thirdly, we've worked with the Department of Education and the Department of Treasury to press for more refinancing options for people, particularly with private student loans, which have largely been unavailable to them in the past. There's a lot of movement on that, and there's progress on that. Fourth, one of the things we're trying to call attention to is a lot of this is a matter of public policy, and it's said either at the federal or state level or both, is that the amount of student loan debt in this country is itself becoming a negative drag on our economy. Younger people are forming households later. There's forming small businesses at lesser rates than in the past. They're making different choices because of the amount of debt that they have. It's affecting the broader economy. We need to rethink public policy in this country. It goes well beyond my limited mandate, but it's something that we think needs to be aired and needs to be discussed, and policymakers need to think more about it. So we're trying to be active on all fronts. Another issue is a lot of these student loan issues affect service members who are trying to figure out what to do with their GI benefits and/or other student loans that are available to them, and make sure that they don't go to waste and that they benefit by them. And we've, with Holly Petraeus, who heads the Service Member Affairs Office, we've been working with both Department of Ed, but also Department of Defense and Veterans Affairs to make sure that service members can really maximize their benefits in ways that will improve their lives as they come back into the civilian population. So a lot of different fronts for us. A very big problem, very big concern, and it should be a concern for anybody making policy in this country.
I want to thank you for all those things that you're doing, but I want to jump to another point that I want the record to show, that a year ago, the Bureau announced an action against the former for-profit college chain Corinthian Colleges Incorporated in response to a scheme that lured thousands of students into expensive loans and conducted abusive collection tactics that preyed on students. Moving forward, do you expect that the Corinthian experience will inform the Bureau's work with respect to institutional student loan programs at those for-profit colleges?
Yes, and thank you. I meant to wind up with that work, which has been very aggressive on our part, and we've been working with state attorneys general and other partners, Department of Education, Department of Justice, and others. We did bring the action against Corinthian. We thought that they had misled students in significant ways and engaged in various predatory practices. Obviously, others have felt the same, and they are now in a bankruptcy proceeding. We have sued ITT, which we think have engaged in many of the same practices. We continue to monitor that market. It's been a source of a lot of harm to people, and it needs to be thought about more carefully.
Thank you for your good hard work on this issue. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Posey.
Thank you very much, Mr. Chairman. Good to see you again, Mr. Cordray.
Thank you.
I want to go back to something that one of my colleagues across the aisle, Mr. Meeks, mentioned just a little while ago, and that's a concern my colleagues in Florida have about our earlier experience in Florida with short-term lending. The legislature in Florida worked hard to balance the needs of the citizens of Florida for short-term credit with consumer protections. The Florida experience has been a positive for Floridians and shows the value of state legislatures who desire to action to meet the needs of their local communities. As the CFPB considers regulations of short-term lending, you have said that your rule will be just a, quote, floor over which the states can regulate. However, I've been told the proposal that the CFPB has released is in fact a floor that no existing state law meets, period. So it is effectively a preemption. And that's why I think you've seen so much concern within the Florida delegation and others, New York now. Do you intend to follow through with your rule that effectively throws out the hard work of the Florida legislature and that of 31 other states, for that matter, that have acted to regulate responsible payday and other short-term lending?
So one of the things I've found is there's a lot of people saying to us on payday lending, vehicle title, certain installment loans, they're saying to us, oh, you really shouldn't do anything. You should just leave alone what the states are doing, and it's all fine, all right? We did 2 extensive white papers, largest research that's ever been done on this issue, that showed that a large number of consumers under these existing regimes end up trapped in debt, getting 8, 10, 12 loans in a cycle, paying more in fees than they ever borrowed in the first place. Some of the stories are quite gross, and I can't in good conscience just leave that alone. If we can make reasonable interventions to improve this market so that consumers are not victims of predatory lending, I think we have an obligation to do that. As to Florida in particular, you and I and your colleagues have had a number of discussions about it. One view of Florida is it's really fine, it's a model for the nation. Another view that consumer groups in Florida have put forward, Consumers for Responsible Lending did a report, and other groups have written to the delegation more recently. They've said it's actually still problematic in various ways. A lot of people end up rolling into these long sequences, and the percentage of people who reborrow is just as high really in Florida as in the rest of the country. That's what our analysis has showed as well. Again, I was referring earlier to an example from Missouri. This is a judicial opinion. The judge was so offended, they went to the evidence record there and indicated, for example, class member DW took out a $100 loan from this company. This is in the record. A judgment was entered against him for $705.18. There was a garnishment of his wages. So far, $3,174.81 has been collected on a $100 loan, and a balance of $4,105.77 remains. That's the kind of thing we're seeing around this country. We can all talk about access to credit, and all credit should be allowed, but some of this is quite predatory, it's quite problematic, and this is something that we need to address. And I feel strongly about it, and I don't feel in good conscience I can just give it a pass and move on to other things.
Well, I don't know what they do in Missouri. I heard somebody from our financial services office in a meeting. You were in the meeting.
Yes.
I think you heard him say he had 2 complaints out of how many hundreds of thousands. I mean, it was just an incredibly, that kind of shocked me, which indicated to me that Florida, maybe in some states, got some things right. But it seems if you come out with your floor that a standard that no state can meet, your effort to protect some people is going to have the unintended consequence of hurting people. I don't think anybody chooses to go to a payday lender. I heard somebody from your agency say, well, we'd like to get these people to be more involved going to credit unions and conventional banks. Yeah, except they will not make the loans a payday lender makes. When somebody goes to a payday lender, they're usually pretty doggone desperate. And the next step is I don't even want to mention it. I mean, there's 3 ways people get through life. If they're not independently wealthy, they work, they steal, they're in welfare. So if you don't have jobs for people, you really can't complain when you have the bad 2 scenarios. And it's a similar thought with payday lending. When you don't have some conduit for these people to survive, you're asking for trouble.
Time of the gentleman has
fair
expired.
points. Yeah.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Clay, Ranking Member of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank you, Director Cordray, for being here today. We've heard a lot this morning about auto loans and credit related to auto loans. A February 2015 settlement announcement from the Department of Justice against 2 North Carolina-based buy here, pay here auto dealers for violations of the Equal Credit Opportunity Act alleged reverse redlining, finding that the dealerships intentionally targeted African American customers in extending high-cost auto loans when the borrowers otherwise qualified for more reasonable interest rates. Mr. Cordray, how concerned are you that the recent growth in the subprime auto lending may also include the kind of reverse redlining that the Department of Justice uncovered just in February 2015?
Yeah, and by the way, buy here, pay here auto dealers are somewhat, they're different part of the market, and again, when you say the CFPB isn't sure if it's legal authority, one of the things we try to do is be very careful about a legal authority. We discuss it a lot. We try to analyze it carefully. We try very hard to be on the right side of that rather than the wrong side. If we're on the wrong side, courts will smack us down, and they may do that from time to time, but we're trying to be careful about it. And we've investigated buy here, pay here auto dealers because they pose a somewhat different and special risk, I think. What was your question?
Well, it was, I mean, how are you addressing it? I mean, the reverse redlining.
Yeah, okay.
Could you elaborate on the
Right.
buy here, pay here business model?
Okay.
And are there unique risks associated with the buy here, pay here business
Okay.
model?
So, and reverse redlining is not unique to auto, it's also in mortgage. And we took an action against National City that got back, and it got back to consumers, $25 million in compensation because of reverse redlining in the mortgage market. In the auto market, same types of concerns, although I will say I don't think the right answer is to cut off auto lending to people who have less than perfect credit. People need to have transportation in most parts of the country, certainly in my part of the country, in order to get to work and make something better for themselves. So I don't think it's just because it's subprime that it's wrong or bad. It is the case that when you go into the subprime market, prices tend to be somewhat higher. Some of that is inevitable. It also creates risks because maybe you'll try to exploit those consumers in ways that are not appropriate. That's something for us all to monitor very carefully. The Justice Department has indicated it's monitoring that carefully. We're trying to monitor it carefully. I don't think the right answer is that people whose credit is under, say, a FICO score of 680 should not be able to get auto loans. They need them. And it's actually helpful to their situations. But if people are using that market as a means of engaging in predatory conduct, and we saw it in the mortgage market, so it's certainly a risk.
Sure.
That's something we should be very careful about.
So, in other words, my colleagues should not be naive about the fact that some in this industry are steering people for no other reason than because of the color of their skin into high-cost loans.
If somebody qualifies for a prime loan and they're being steered into subprime loan, that's the kind of abuse that we would want to take action against. But if someone is it has just less good credit and therefore they're subprime customer, the notion they shouldn't get a loan for that reason is not a right answer, I think, either.
Thank you for that response. Let's shift over to the to diversity and inclusion. What role has the Office of Minority and Women Inclusion played in helping the CFPB recruit a diverse and qualified workforce?
They've been very instrumental for us, and I've had a number of discussions with some of you, and particularly with the ranking member, on the importance of the Office of Minority and Women Inclusion, which was, of course, created in Dodd-Frank and applies to all of the financial agencies. In response to work that we have done and some issues that we have worked to address, elevated that role within the Bureau. It is at the highest levels, and that office has been incredibly helpful to us, both in understanding our own workforce, understanding our recruiting and hiring, understanding our retention, and also thinking about our contracting and trying to work as aggressively as we can with the other regulators in the industry to see that practices change there as well. I would say it's one of the successes of the Dodd-Frank legislation.
Thank you, Mr. Director. Mr. Chairman, I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Virginia, Mr. Hurt.
Director Cordray, over here.
Yep. Come on.
Thank you for appearing before our committee. I represent a rural district in Southside, Central Virginia. Over August, we had the opportunity to travel across the district and met with a lot of folks that live on Main Street and are served by our local Main Street financial institutions. We have heard a lot of concern as we travel across the district about the CFPB and the impact that it's having on these institutions' ability to deliver access to capital. But the question that I wanted to focus on today relates to the Truth in Lending RESPA integrated disclosure rules that are going into effect. And I was and I'll recount for you one conversation that we had with one of those representatives from compliance officer with one of those institutions, and said that they were glad that there was an announced effort to try to streamline those complicated, complex rules that have to be undertaken when closing real estate transactions, but were also concerned about the end product and concerned about the process. So I guess I was wondering if you could talk a little bit about your analysis in terms of the actual costs to consumers. What are will the costs be ultimately? Will this result in a higher costs, and how much extra time will be required, or if you could just talk about that briefly.
Sure. And again, it was Congress's decision that these forms really needed to be streamlined. They've been out there for 40 years, 2 different statutes, 2 different
You all
agencies.
looked at the cost
And yeah.
directly?
Yes, although it was a mandatory rule. We didn't have discretion to say we're not going to do this. We had to do it. We did our best to try to mitigate costs and make it feasible for industry. We spent a fair amount of time over it. I mean, this statute was enacted in 2010, and this rule isn't taking effect until now, almost 5 years later. At the same time, we've been working with the industry extensively to try to help them comply. Trying to provide a lot of guidance, trying to provide webinars.
Are you able to talk specifically about the costs and the analysis that you all have done about the specific costs that will be passed on to consumers, or the time?
I'm not convinced that there are going to be any significant costs passed on to consumers. I mean, it really is a change of forms. There's a lot of angst around the transition, but they made a transition 5 years ago when HUD changed the forms. This probably happened too fast in light of that, but Congress mandated it all.
Okay.
But they did it then, they'll do it now. It'll be a better, cleaner process. Consumers will understand these forms better. That's what our testing has shown. The industry will be benefited because consumers will be both clearer and happier about what they're doing, less angst around the closing, less surprises, unhappy surprise at closing table with a lot of source of dissatisfaction. I think it will be better, but it's a matter of getting through it, and that's what we're on the verge of doing.
And as you point out, the timeline has proven to be a burden to a lot of these institutions, especially the smaller ones that have a hard time. There are a lot of partners in these transactions, and trying to make sure everybody's on the same page is very important. So I guess my question to you is I understand that the CFPB has rejected the request by the industry to grant a grace period for the implementation of this for the next 6 months, let's say, till February. It's my understanding that's been rejected, but I guess my question for you is will the CFPB pledge not to bring enforcement actions against those institutions that are acting in good faith? Obviously, we don't want people abusing that grace period, but will you pledge that you all will do that?
No, it's wrong that we've rejected that. In fact, I saw just the other day an article that may or may not be legislation on this.
So my question,
the CFPB has granted most of what industry wanted. We have done that, and we have made it.
But you haven't offered a blanket grace period for those who are acting in good faith in terms of not bringing an enforcement action. I just would like to get you on the record saying that if that's your position.
What we've done, I think, is actually better for the industry. We have worked with the other agencies, and as I said, this is going to be in writing. I've said it verbally. I've made my commitment, but it's going to be in writing by all the agencies that during the early period, and this may be less or more than 6 months, we will be diagnostic and corrective, not punitive. That means we're not going to hammer people if they happen to get the forms somewhat wrong. We know they're trying to get it right. We know there's no advantage to them in undermining consumers by changing the forms in some way. They're just trying to get it right. And I believe that. And so that's the way we're going to handle it, and that's the way I've talked to the other agencies about it. They agree. I mean, you're a former prosecutor. I know you know law enforcement, and you have to sometimes be a little nuanced about it. We're trying to do that.
Thank you, sir.
Time of the gentleman has expired. Chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Over here, Mr. Carteret in the corner. You know, I served in the Georgia legislature. I was the chairman of the Senate Rules Committee, and there we passed and enacted into law a fairly restrictive state short-term lending law. But even so, online companies like Elevate offer a 59% rate product in Georgia that complies with our state law, and it certainly gives our constituents there more access to good short-term credit. But under the proposed small dollar lending rule, Elevate wouldn't be able to offer this 59% product in our state of Georgia. So my question to you is, how are my constituents who use the credit as intended and needed be better served by a rule that is overly prescriptive and does not complement our existing state law, and that our state legislators have concluded that is in the best interest of our constituents in Georgia?
Mm-hmm. So I will say that this is something we're trying to listen very carefully to you and others who are bringing these different scenarios to us. I am very sympathetic, and the point was been made on both sides of the aisle today, that alternative means of satisfying small dollar credit for people are very important, whether it's credit unions or maybe community banks, or, as you say, companies that are now innovating around trying to find more consumer-friendly methods of supplying that credit that people need.
Yeah.
I'm sympathetic to that. We're trying to work with the rules we're trying to develop such that there will be room for that. If we're not getting that right, we'll be interested in hearing from people about how they think we might adjust it somewhat here or there. And that's something, the product you describe seems to me much more user-friendly than some of the products I've seen out there.
It is, and that helps my constituency. Mm-hmm. I'm going to be working on that, and I'm glad to hear you say you'll work
be glad
with
to
us
have the
so
input.
that my folks in Georgia will be happy. Now to another matter, Mr. Cordray, this business with the auto dealers. Mm-hmm. Okay, first of all, let me say that the CFPB have done some good things, but this business with the auto dealers is a bad thing. It's a bad deal. Now, let me tell you why. There's racism everywhere. We know that. But in the ruling and the guidance that you put out, it was done unfairly. You offered a rule. You charged the dealers with the basis of it that they were racially discriminating. You based that on a report that was shamefully flawed. It was inaccurate. And to tell you the truth, it was downright insulting to African Americans because you just assumed their last name was Johnson or Williams or Robinson or maybe even Scott. But let me tell you, there are a lot of white people with the same names. How can you be accurate? And even yourself, your CFPB, you said that even this is about 25% inaccurate. But yet and still, you directed an extraordinary and deceitful approach that harmed some of the very people that you're trying to help. You've got hundreds of auto dealers that are African Americans. But when you put this blanket indictment, you hurt them. And then you went to the lenders. You pressured them to cut out their ability to discount their loans. The one little measure they got in there in which they can make a profit. Now, you did this without congressional approval. We sat right here in Dodd-Frank and wrote. There's been some discussion about the law. Here's what we wrote. We said, and I wrote this with Barney Frank and many members on this committee. Section 1029 says these words: the Consumer Financial Protection Bureau may not exercise any rulemaking, supervisory, enforcement, or any other authority, including any authority, to order assessments over a motor vehicle dealer that is predominantly engaged in the sale, the servicing of motor vehicles, the leasing and servicing of motor vehicles, and both. And
so I strongly
you say
disagree
you go
with much
after
of
the lenders.
I strongly disagree
not
with
the
much of
dealers.
what you just said, but
Well, you're disagreeing.
where to start? I
read
don't
from
have
the
any
law.
time. No, I don't disagree with the reading of the law. And as I
Time.
said, auto dealers are one thing, auto lenders are another. But I disagree with quite a bit of what you said about characterizing our efforts here to enforce the law.
Time of the gentleman
that
has
are
expired.
compatible with the Justice Department's efforts.
The chair now
to enforce the law.
recognizes the gentleman from Illinois, Mr. Holtgren.
Thank you, Mr. Chairman. Director Cordray, way over here. Thank you for being here. I appreciate you coming. Your testimony is an important opportunity, certainly for us to hear about the Bureau's policymaking, formal and informal, and for Congress to use the limited oversight provided to us by the Dodd-Frank Act. First of all, I was drawn to the part of your testimony that I think awkwardly tries to make the case that community banks and credit unions are faring well in the current regulatory and economic environment. I assume you read the American Banker, but just in case you don't, I wanted to flag some stats from a story that was published on Friday. It said, today there are 1,524 fewer banks with assets under $1 billion than there were when Dodd-Frank was signed into law. Also said the number of banks with under $1 billion in assets fell by 5.6% in the second quarter. This is the second largest percentage reduction since 1984. The annual shrinkage rate in the number of banks under $1 billion has accelerated every quarter but one since the third quarter of 2012. As I have observed the Bureau over the last few years, I've become increasingly concerned it is more interested in expanding its influence than in protecting consumers' access to financial products and services. The revised QM rules for small creditors and those operating in a rural or underserved area was released by the Bureau last week. I appreciate many of the considerations you made for these lenders. However, the entire Illinois delegation, House, Senate, Republicans, Democrats, made a recommendation that the CFPB that economically challenged areas be included in the definition of underserved areas. Why did the CFPB avoid an opportunity to make this common sense change that would have eased compliance for community lenders and improved access to credit?
Okay, so the two parts to your question. First part on community banks. I think you're just wrong on the facts. Community banks'
My
revenues
question was
are up,
specific to this.
and market share is up.
Economically
and
challenged.
They're lending more.
That was a statement. So you can comment on my statement, but my question is, economically challenged, why, again, this was Republicans, Democrats, House, Senate, all said this is important, please do this, and you just ignored it. And I wonder why you did and why you wouldn't put this common sense change in there. That first question.
Okay, so
Only question.
we've done 2 or 3 rounds of rulemaking now on the meaning of rural and underserved. We've heard a lot of comments on those, and we've done our best to digest those comments and reach conclusions. We have, in all these cases, expanded the coverage of that in so as to benefit community banks and credit unions. And have considerably done so. If you
They
look back,
are not feeling it, and the American Banker article clearly
Well,
says that. I only have 2 minutes left, so I want to get to my second question here real quickly. Again, this is bipartisan, Republicans, Democrats, House, Senate, asking, please, common sense, this makes sense, please do it, please take another look. Second question, I want to talk to you a little bit about how your agency chooses to engage the media and the public. I've noticed your press office is much more aggressive and inflammatory than any other financial regulators. First of all, your agency is well known for its use of midnight embargoes to create one-sided stories. Additionally, these press releases frequently use language that misrepresent the facts. In the Bureau's semi-annual report, you cite 45 public enforcement actions in the preceding calendar year ending March 31st, 2015. In many of these standalone enforcement actions, most commonly resulting in consent orders, the report and press releases describe the Bureau as finding or ordering companies to conform to a judgment determined by the Bureau. Do any of these standalone consent orders admit any facts or guilt?
so ordering is certainly accurate. And when we say finding, we tend to be careful about this language, but usually this is the result of a prolonged investigation by us, sometimes in conjunction with other agencies, including the Justice Department at times, or other financial agencies, or states, who are all joining the investigation and reaching the same conclusions. So the notion that we're somehow off on our own doing crazy things, when we're typically working with partners who are themselves law enforcement partners and reaching the same conclusions, I think speaks for itself.
But even with your statement, since liability has not been proven in a court of law, why does the Bureau issue over-the-top press releases that state facts that are not proven? Why does the Bureau try to insist a company has violated the law if it has not proven it did so?
I don't think that's fair characterization. I don't think they're over-the-top press releases.
If you look at the press releases,
we're calling attention to practices that usually a result of a prolonged investigation. The facts are usually clear enough that the institution wants to resolve. without further proceeding because they
what we do
recognize the
here is
problems.
we have several
and they're
different
going to clean up the
regulatory
problems.
agencies that come and report to us. We see the difference, and it is such a glaring difference to us of what CFPB is doing. I'm just asking you, look at the other departments of what they're doing. Your press releases are so far over the top.
No, I don't think so. Look,
They
often
are.
we issue joint
Who writes your press releases?
Often we issue press
Who writes
releases,
the press releases?
in matters where state AGs issue press releases as well. I don't think there's a
Who writes the
difference
press
between them.
releases?
I don't think the Justice Department's
My
press
time is
releases
almost
are
up. Who
different
writes
from
your press
ours.
releases?
So, many people at the Bureau are involved in writing accurate, fair accounts of our matters.
It doesn't look that way. My time has expired. I
And,
yield
and
back,
by the way,
Chairman.
when the
My time
institution
has
agrees
expired. I
to
yield
change
back.
their practices
Time
going
of the
forward,
gentleman
that's,
has
that's
expired.
a significant
The chair
admission
now
that they need to change.
The time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you, Mr. Chairman. I want to thank you for calling this meeting, as well as Ranking Member Waters. And I welcome you, Director Cordray. And as you know, I'm a big supporter of CFPB, under your leadership, I might add. And I think you've done a fantastic job. I believe this report is absolutely excellent that you're issuing. And your statements, your press releases, and your actions have all been data-driven and factual, and I want to congratulate you. And the numbers speak for themselves. The Bureau has returned over $11 billion to 25 million consumers who have been harmed by illegal consumer practices. The Bureau has also gone out of its way to help our men and women in the military through the Office of the Service Member Affairs led by Holly Petraeus. And you have shown great flexibility and reacted to letters and inquiries from members of this panel and the public as well. And I want to give one example. The Bureau helped stay-at-home spouses by clarifying that the Credit Card Bill of Rights, the CARD Act, did not prevent stay-at-home spouses from taking out credit in their own names. And this was a bipartisan request for clarification, and we want to thank you for that. Now, I'd like to ask you about co-ops. As you know, co-ops are a big part of New York City. Many thousands of our residents, hundreds of thousands of our residents, literally live vertically, not horizontally. And unfortunately, there's a great deal of uncertainty about whether co-ops are included or excluded in the Bureau's new integrated disclosure rule for mortgages. Co-ops have always been treated as real estate under both TILA and RESPA. And so lenders to co-ops have always provided the same disclosures as everyone. They've always had the same. But under the Bureau's new integrated disclosure rule, the Bureau did not specify whether co-ops were still included, as they always have been under federal law. Different lenders have come to different conclusions about whether co-ops are included in the rule. Some say they're included, some say they're excluded. Now, this is a big problem because if you're not allowed to voluntarily comply, you're not allowed to voluntarily comply with the integrated disclosure rule without violating the law. And this is a rare situation where the co-op industry thinks that you and your Bureau has done such a good job on the integrated disclosure rule that they actually want to be included in the rule. So I'd like to ask you, for the record, can you take this opportunity to clarify that co-ops are in fact intended to be covered by the new integrated disclosure rule?
Yeah, thank you for the question. I don't know that I can today on the spot at this moment. I know that our staff has been talking back and forth to your staff as you brought this issue to our attention. And as we've been looking at it and trying to understand it, it feels that the issue can vary in different parts of the country depending on state law. Now, whether that's the right answer or whether that's just the current answer, whether we should be more specific somehow here is something that I believe we've taken under consideration and we are considering, and we'll continue to talk back and forth both with your staff and any other members who are interested in this issue. Maybe others from your state would be interested in it as well. I'd like to get it right. I'd like to be satisfactory, as you say. You know, I'd like to, if people like our forms and want to be covered by them. I would like that to be the answer, but I can't tell you today exactly how the legal issue comes out here as we're trying to work on it as we speak, I believe.
Okay, I'd also like to ask you about overdraft fees. As you know, I've been focused on overdraft fees, which can be outrageously high and eat into consumers' hard-earned savings. In fact, I'll be reintroducing Mr. Ellis's and my Overdraft Protection Act next week, and my bill would ensure that overdraft fees are reasonable and proportional to the amount of the overdraft, which would end the $35 cup of coffee. But I want to know, are you still working on this? When are you going to come out with it? And are you going to be looking at mainly disclosure on overdrafts, or are you considering some more substantive limitations on overdraft fees?
Yeah. Yeah, and we're well aware of your interest in this, and you've been proposing legislation on it. We are working on it right now. I think there may be some misunderstanding because we recently put out to start some consumer testing around disclosure, but that does not signal that that's the only thing we're thinking about in this regard. I agree with you that there's a broad set of issues here, some substantive, some may be handled by disclosure for us to try to figure out. It's not a suggestion that we're narrowing our scope of our inquiry here.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Mr. Chairman. Director Cordray, over here.
Yep.
Pleasure to see you again. You and I have had multiple conversations with regard to the payday lending industry. I've explained in the past that I was active in the Florida legislature in initiating legislation that corrected a very bad market, a very terrible market for consumers in the payday lending industry. As a result, I think we have probably the best state-run payday lending institution anywhere. We protect our consumers, we limit what they can do, but we also make sure that the bad players are not in there. Now, the fact that we're here talking about payday lending doesn't mean that I'm here talking on behalf of payday lenders. No, I'm here on behalf of payday consumers. The fact that they have a paycheck means that they have a job, which means they're working hard to meet the needs of their family, to better their life. And yet, when they have a need for capital, when they need a short-term loan, according to Commissioner Breakspears in Florida, your proposed regulations will absolutely eliminate this source. It will absolutely delete any opportunity for these hardworking taxpayers to have access to capital in a market where nobody else will fill that void. Have you had a chance to talk to any of these payday consumers?
Yes, I have, and I've also had a chance to talk, as you know, extensively with Commissioner Breakspear and with folks about the Florida structure, both members of the Congress who are very interested in it, I've seen, and people from Florida, providers and consumer groups. And there are different points of view on that regime. Not everybody thinks it's the greatest thing since sliced bread.
But eliminating the supply will not eliminate the demand. And these poor consumers who are trying to make ends meet will now be subjected to usurious lenders, mostly offshore. Maybe Cousin Guido or somebody that has interest rates that they can't afford. Yep. We're not doing any benefit for the consumer, and yet that is your mission. Now, when you promulgate your regulations, I would assume it's done based on objective evidence. You would look at your data that you may collect. And I would assume that you would look at how bad the industry is in terms of how many complaints have been registered in the payday lending industry. And according to the CFPB's complaint database, since its inception by product, only 3,030 complaints have been filed against payday loan companies. That's less than 0.1%. At what point do we say that that's egregious?
Yeah. So first of all, we staged products over time. Payday was one of the later products to come online, so that's one piece. Another piece, what we find is that consumers may be characterizing a complaint in one way where it's actually another. A lot of our debt collection complaints actually turn out to be joint debt collection payday complaints.
Still only 3,000, less than
No, that's which suggests that's not the right number, okay? But it's a fair point, and again, for us, one of the things we're trying to figure out is we want there to be access to credit. We understand the needs people have, and we've heard a lot about it in individual situations. But if it's credit that is going to roll them into sequences of 8, 10, 12 loans, paying out all those fees, and it still happens under Florida law.
And if I might point out under the Florida law, over last year there were nearly 8 million payday transactions. And according to the Florida Office of Financial Regulation, there were only 117 complaints. Sounds like something's working. And I think we need to take a look at that. I think if we're going to look
it's a relevant datum. I agree.
Relevant. It's compelling. Because where
I
are
don't
these
know that
people
it
going to
is.
go? Where are these people going to go when they can't make ends meet? When it's 11 o'clock at night and they need to be able to get lunch money for their children? When they need to be able to pay the rent? Are they going to go to a bank that's not open? Are they going to go to a non-bank lending institution that doesn't want to touch these but rather do long-term loans?
This is why we're looking at the different regimes in all 50 states. There are 13 states where no payday lending is allowed. That doesn't mean that's the answer we're going to come to, but in 13 states, it's not allowed. What do the people do in those states?
And
they
I'm
do
here to
something.
tell you that there's a good guidance to follow, and that's the state of Florida. Now, I know that in a conversation you had some time ago, you indicated that Florida has, that consumers are charged up to almost 300% per year. I take issue with that, and I just wanted to know where you might have gotten that issue.
I'm sorry, what's this?
That they pay up to 300% per year APR on their payday loans.
In Florida?
Yeah.
That's my understanding, and consumer
I take
groups,
issue with that, and I
again,
disagree
consumer
with you.
groups don't agree with you on that.
Well, the one thing I would just please ask you to do, these are hard-working taxpayer dollars. They have a job, as evidenced by the fact that they have a paycheck. My concern is not for the payday lenders. My concern is for the payday consumers, and I ask and I plead with you to make sure that we keep this industry alive, protect our consumers, and I yield back.
Okay, thank you.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman. And I thank the ranking member as well. I thank the President of the United States of America, the Honorable Barack Obama, for appointing you, Mr. Cordray, to this position as the director of the CFPB. And I thank him for doing so because he appointed someone with courage, someone with intestinal fortitude, someone who's willing to stand up for consumers. It's just not easy to do. You have been through the fire and the storms. Just getting positioned required an inordinate amount of effort. And I'm grateful that you're in the position that you're in. And let me just say one more thing. This is not really a part of what I'm called upon to talk about today. But I'm proud to serve under the leadership of the Honorable Barack Obama. I'm saying it because too often so much is said about him on the negative side, such that people assume that everybody in the room thinks negatively of the president. I do not. He's been elected twice. It was no fluke. And I just don't want the record to show that there were some of us who acquiesced when statements were made that we should have objected to. I'm proud. Now, Mr. Cordray, you're not saying that all auto dealers engage in invidious discrimination, are you? I assume your answer is no, you're not. Is that correct?
That's correct.
And you're not saying that all, by the way, this is not under the purview of your bailiwick, but all investment advisors are engaging in invidious discrimination, or all mortgage lenders. But
I don't think anybody in any industry.
Absolutely. But those that do are the ones that we have to stop.
Yep.
Do you agree?
I very much agree. It's a law enforcement obligation and duty that we have.
And I saw you anxiously desiring to respond to some commentary that was made earlier, and you did not get the opportunity because time was limited. But as it relates to the auto lenders. So would you take a moment, please, and give your response before I continue with my concerns?
Sure. We're not trying to make up problems to address, but when we see problems and they're brought to our attention, and again, in the auto lending, it's not unique to us. The Justice Department feels just as strongly and feels the same way as we do about the concerns here. So, and they've been at this a lot longer than we have. We feel that when people go to get an auto loan, and lending programs have been established by lenders, even though they may be executed by dealers, that allow and that bless high risks of discrimination based on race or ethnic origin or other prohibited characteristics, that's an issue we need to investigate and we need to try to address. And if we can find a way to address it that mitigates and roots out the risks of that, but at the same time allows the industry to do what it does best, which is sell cars to people and give them the opportunity to have transportation to get to work, which is so important for people's economic well-being. That's what we're trying to accomplish, and it's a balance. And it's, you know, people can look at it and say we're getting the balance wrong, or they can say I disagree with this or I disagree with that, or the methodology here seems complicated and I think you don't have it right. We always try to listen to that, and if we can adjust and take account of their concerns, we try to do it. The fact that we do have those discussions frequently
With less than
doesn't mean
50
we're
seconds
wrong.
left, Mr. Cordray, let me go
Yeah,
to
just
something
means we're
else
trying to get it
quickly.
right.
Let me do this quickly. There's been much said about how powerful you are, but isn't it true that FSOC, the Financial Stability Oversight Council, has within its purview the authority to override decisions that you make in terms of rulemaking?
They do.
And
No other agency is subject to that. But
only agency
Yep.
subject to this. And isn't it also true that your rules are subject to judicial review?
Absolutely.
And isn't it true that while you are confirmed by the Senate, you have to be, that you can be removed by the president should the president find that you have not behaved properly while in office?
For cause, that's my understanding. Hopefully that will not.
And isn't it
happen.
true that you're also subject to audits by the GAO?
Yes, every year, in fact, more so than I think many agencies are.
So while you do have some authority to help consumers, you're still regulated yourself. Is this not true?
I think extensively, including coming here at least twice a year and to the Senate at least twice a year and hearing your oversight, which I take very seriously. I don't feel that I can sit here, listen to concerns you raise, and then not pay attention to them. I think that's important for me to do that.
But I want to close with this, Mr. Chairman. There was some mention about African-American auto dealers. If an African-American auto dealer engages in invidious discrimination, that person ought to be stopped too. Doesn't matter about your color. You ought not discriminate against people regardless of who they are.
Gentleman's
I
time
yield back.
has expired. With that, the gentleman from North Carolina is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Cordray, I have in my hand the annual employee survey, December of 2014, of your employees. And then question 57, it says, how satisfied are you with the policies and practices of your senior leadership? Ms. Cordray, less than half of the people questioned were satisfied with the policies of your leadership. This must be very disturbing to you as you consider that these individuals have worked with you for the last 4 years and have followed these policies. How do you account for this, what's happening within your borough, and why do you believe that you've been given such a vote of no confidence by your own employees?
So first of all, I think I would agree with some of the employees at that point in time. I thought that there were reasons that I wasn't satisfied
Excuse me,
with.
this is December 2014.
I understand,
This
and
is just
what
a
I'm
few
saying
months
is,
ago.
what I'm saying was, I wasn't satisfied with our senior leadership, including myself at that time either. We'd had significant problems with our performance management system. You know, that needed to be changed and fixed, and we were in the process of doing that. And that was a source of a lot of dissatisfaction for our employees, and I agreed with them on it.
Autonomy and authority to write rules and regulations. They don't apparently like your policies.
No, it's the different things here, okay?
Well, no, that's
These
a
are
real thing.
operational issues, but I will say, we've just had the new annual employee survey this year. There's a significant positive increase, which I've been pleased to see.
I'd love to see
You'll
that
have a
report.
chance to
Let's
see
go on
that
to my
as well.
next question, because I'm sure you were disturbed by that. Let's look at this. You know, your employees have come forward and said that they've been subjected to discrimination, retaliation, other kinds of maltreatment. How do you account that there's no single manager that's been held accountable for what's been done?
So again, a lot of this stemmed from the performance management system, which was unsatisfactory. And we've scrapped that system, and we're working with our union to overhaul it. But I just want to say, since you're raising the AES, the unemployed survey, the most recent numbers indicate that the diversity inclusion index from our own employee base is higher than it is for any, higher than it was last year, higher than it is government-wide. So although there are some people, who are dissatisfied, and I take each one seriously, the overall tenor at the CFPB is very positive.
Given what we've seen in the various departments and agencies of government, I don't believe I'd use that as a reference. Now, according to the Bureau, only 3.8% of all consumer complaints in the last 12 months have received any actual monetary relief. Does this mean that most of these complaints are without merit? Or does it mean that you're remarkably deficient in obtaining financial relief for these consumers?
So first of all, I would say that the consumer complaint system that we've set up is revolutionary among federal agencies and the federal government. We're getting more relief for people than anyone has ever gotten before.
Excuse me, sir, 3.8% of all consumer complaints, only that number received in the last 12 months any monetary relief.
Okay. So a lot of them are, on a debt collection complaint, the issue may be stopping the harassing phone calls. On a credit reporting complaint, the issue might be cleaning up my credit report.
Question. Does it mean that most of these complaints are without merit?
No. As I'm saying, just listen for a moment. On a debt collection complaint, different kinds of relief that is not monetary is very important to people, and the same with credit reporting. There's a whole bunch of complaints where monetary relief is not the immediate issue, although it has monetary consequences. If I get my credit report cleaned up, now I can get a loan. That has a lot of consequence, but it wasn't that money came to my pocket immediately.
Let me ask you this, sir. The CFPB has promulgated rules that have impacted credit unions and community banks, enforced by the FDIC, the Fed, OCC.
Yeah, NCUA, yeah.
Do you see any relief that you've given to reduce the regulatory burden for these entities? I work with these entities on a constant basis. I was on a community bank board for a decade.
I know you were. Yeah, I know you had that background.
And yet I see here time and again how they are faced with such burden and compliance. They're hiring more compliant officers than they are loan officers and development officers. How do you account for that?
So take our mortgage rules. Okay, we had special provisions that we created in there to create special coverage for community banks and credit unions. 98.5% of the credit unions are covered by those. The credit union share of the mortgage market is up since our rules. How do you explain that?
Well,
I mean, this is positive in many respects for some of these smaller entities.
Housing markets come back.
They are the responsible lenders, and we support them.
Gentleman's time
And the
has
community
expired.
banks have come out, have left that business as well.
Gentleman's
No, it's not true in the Humboldt
Gentleman's
data.
time has expired.
That's a myth that's not necessarily being borne out.
Gentleman's time has expired. With that, the chair recognizes the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. Thank you for being here, Mr. Cordray. Mr. Cordray, my first question, let me associate myself with the comments of my colleague, Mr. Green from Texas. I thought he spoke quite eloquently for many people in this country. My first question is, Mr. Administrator Cordray, can you tell me what the approval rating of Congress is?
I don't know.
I do. It's 14.
14%?
14%.
Okay.
14 is up from 9.
50% increase.
My point is 50% of your employees say that they're dissatisfied, and 90% of the people say they're dissatisfied with us.
And my point about that is if 50% are satisfied and 50% want us to do better, I want us to do better too, and we're working to do better. That's the only appropriate way for us to address these issues, and that's what we're exactly trying to do.
Yeah, I agree, and I appreciate what the agency is doing, and also your flexibility. I've said many times I was in here, as were a few of us, when Secretary came in, sent over from the White House, Hank Paulson and Ben Bernanke and others came in this very room and told us what was happening, and that we only had a short time to respond, and we did what we thought was in the best interest of the country. I listened to Ben Bernanke this past Sunday on one of the shows, and he said he thought that the Great Recession was worse than the Depression because of the whiplash that's still being felt. And one of the things we did, we did a lot of things trying to bring the country out. Obviously, some of those things worked because we are a much healthier nation economically now. We tried and failed, I will admit, to reduce the big banks. Too big to fail was something we all were interested in, but what happened was the red tape has become so costly that we have unintentionally pushed more and more consolidations and concentrations of the financial services world. We didn't intend to do it. Now, that's not your fault. That's not the agency's fault. I went into one of my banks in Marshall, Missouri. Well, there's only one bank there. And they put the regulations on a desk so I could see how high they were. And it was quite impressive. The agency didn't do that. Congress did that. We did that, albeit unintentionally. I looked, one of my favorite chairs was Mr. Oxley, Republican. On the other side was a fair and good and decent guy. I speak at one of his forums once a year. I think he's great. The Sarbanes-Oxley Act, I think it was in the early 2000s, I can't remember today, but they had, I think, 16 rulemakings, and I guess your agency had hundreds and hundreds of rulemakings to do.
My agency?
Yes.
I don't think it's been hundreds, no.
But you had more than 16.
Probably, including a lot of little ones, yeah.
Yes.
Possibly. Yeah.
So what has happened is that community banks, which no one intended to hurt, not Republicans, not Democrats, not anybody. I don't think there's anybody in this room who intended for community banks to be in the conditions they're in terms of many of them struggling just to maintain their assets. And what I'm hoping, to finish my sentence, if everybody disagrees, it would seem to me that it's logical if we had men and women of goodwill to sit down here and figure out a way to bring some legislation forth to provide relief to the community banks.
All right, gentleman's time has expired. With that, the chair recognizes Mr. Rothfuss of Pennsylvania for 5 minutes.
Thank you, Mr. Chairman. Director Cordray, welcome this afternoon. In September 2014, the GAO published a report requested after industry participants and members of Congress raised questions about the nature and scope of the Bureau's data collection activities. The report found that the Bureau has undertaken 14 data collection projects, including the monthly collection of data concerning up to 600 million credit card accounts and 127 million mortgages, as well as consumer credit reports. This can only be characterized as an unprecedented big government grab of individual financial records. In fact, George Mason University economist Thomas Stratman has estimated that the number of credit card accounts for which the Bureau wants to collect consumer information is some 70,000 times greater than is necessary for the agency to execute its regulatory mission. Leaving aside the fact that Americans have a fundamental interest in not having their purchases tracked by the federal government, there is also the risk of data security breaches and compromising of personal information. When testifying before the committee before, even you admitted that the Bureau's data collection is not secure and could be hacked. Since then, of course, we've witnessed the Office of Personnel Management, another federal government agency, admit that it allowed more than 22 million Americans to have their personal information stolen. So why should Americans trust the Bureau with their personal information any more than OPM?
So first of all, I'm always eager to hear from you on this issue because I know you have background and expertise in information management. What I would say is, first of all, we try hard, and virtually all of our data collections are done on a sampling basis because we've heard and agree with the concern raised about why you get more information than you really need to monitor the market, which is all we're trying to do. Second, I'd be the last to say that any database is immune from being hacked. I mean, OPM, Target, Home Depot, you know, big banks, everybody's under fire these days. But I do think that we are making sure that we comply with every reasonable standard that is in place across the federal government, which again is not the be-all and end-all, because OPM got hacked. But also, our data is less interesting to the hackers because it's anonymized. They can't get credit card numbers. They can't get names. They can't get personal information.
Are you familiar with the recent article in Science magazine where they used only 3 months of anonymous credit card data? They were able to re-identify 90% of the individuals with some reverse engineering.
This was from what database?
Recent Science article.
But what database were they talking about?
I don't have that.
And we're talking about the CFPB's database, I don't think.
Well, going back to the CFP database, I mean, you just mentioned data sampling. Collecting 600 million credit card accounts. That's data sampling?
No. The only place we haven't done sampling is on the credit card data because we're simply getting the same data that other agencies have already gotten, and the industry has told us it's more efficient for them to just give it rather than them having to create a representative sample. It's a cost issue for them. Now, if you're telling me that regardless of the cost, we should do something different, but we're doing exactly what other agencies have done. It's the very same data. It's swimming around out there in the private sector all over the place, that's for sure. But in our case, it's anonymized, and therefore it's really not of that much interest to hackers, I would think, because they can't.
Except to the extent that it can be reverse engineered. But Director Cordray,
they'd have
the
to
Bureau's
really work the
consumer
reverse.
complaint. I only have a minute and a half left. The Bureau's consumer complaint database has come under heavy criticism since its July 2015 rollout for publishing complaints and allegations of wrongdoing without the Bureau actually verifying that all of the underlying information is both accurate and complete. There have also been reports from the Bureau that the Bureau has failed to scrub personally identifying information from some of the CCD complaints that have already been published, thereby putting individuals' financial information at risk. And recent reports from the Office of the Inspector General have identified noticeable inaccuracies and other shortcomings related to the management and maintenance of the database. What does it say about the Bureau and the database that there have been so many problems associated with this database?
Yeah, I think our data collection has been scrubbed pretty hard by the GAO, which did a year-long review of this at Senator Crapo and others' suggestion. And they made a number of recommendations which we have implemented, which we agree with. The Inspector General's looked at it and had further suggestions.
Well, what kind of process have you put in place to what kind of process have you put in place to identify complaints that are materially inaccurate or identifying complaints that were not submitted in good faith?
So in terms of consumer complaints in particular, the process is that they are submitted to the company. The company has an ability to decide whether that is actually a customer relationship or not. There's various screens on this. But I want to go back. You know probably better than anyone in this room, better than I do, that in the issue of data collection and data integrity, it's an ongoing process, and it's a constant evolution where you think you've met the standards and then something new arises and you're kind of chasing the goal all the time. We're trying to do that. We're trying to do it very carefully. We're trying to keep up with all of the latest standards, and we have been meeting them. But it's a challenge. I mean, I would agree with you. It's a big challenge. The banks feel the challenge too.
Going back to the earlier question, but it'd be easier if you didn't have hundreds of millions of these credit card accounts.
Yeah, the credit card is the one place we haven't done sampling for cost reasons, and I'd be happy to talk further with your staff about it.
You can do that on the other time, but thank you. Gentleman's time has expired. So with that, the chair recognizes the gentleman from Minnesota, Mr. Ellison, for 5 minutes.
Allow me to thank the chair and the ranking member. Mr. Cordray, thank you for all the great work you do. I don't want to go into it. Other people have done it. It is somewhat surprising to me that you have to put up with all of this when you've done so much good for American consumers. But the reality is that, you know, American consumers are at work They don't have lobbyists. They don't have people to pressure them to pressure you. So, anyway. I want to applaud your work on considering a rule to end payday lending traps. I hear from constituents, both borrowers and pastors and other leaders in the community about damage these short-term high-cost loans do. In fact, I had a meeting with a group called Isaiah on payday lending and the work you're doing. And on the screen is a map of payday loan laws which show great gaps in consumer protections. And I want to urge you to move forward with the proposed rule. And I've discussed the agency's March statement with my constituents at this meeting with a group called Isaiah in Minneapolis. And at this time, my constituents seem to be leaning toward option B, which is loans could require a borrower repay no more than 5% of the consumer's gross monthly income. Could you give me an update on your payday lending rulemaking, and what are you considering to do moving forward?
Yeah, and it's an ongoing rulemaking, and it's a difficult rulemaking. It's a surprisingly complicated rulemaking that we're trying to work through carefully. What I will say is we have put out a framework that is out there that people have been shooting at, and some people like it, and some people have suggestions about it, that we think it's very important to establish a principle that the lenders on these loans verify and assess the ability to repay of the borrower.
Yep.
And if there's going to be exceptions to that, because maybe people think that's too onerous to do, although it's pretty normal in a lending borrower relationship, that maybe we allow certain kinds of alternatives where they don't even have to do that, but as long as they can't catch consumers in debt traps and roll them over and over and over again. One of the things that I'll say is that's been notable to me over the past year is we've had a lot of faith groups come to see us on this issue. And they have been Protestant, they have been Catholic, they have been Jewish, they have been Muslim, they have been fundamentalist, they have been progressive, and they feel very strongly about this issue. And they feel very strongly that reasonable steps need to be taken to address some of the harms they see in their congregations, in their synagogues, in their mosques. And that has had a powerful effect on me. I think that this is an issue that people in the communities who care about others and who see the problems coming to them, maybe they're not complaining to the financial banking regulator because they don't realize that's who it should be, but they're complaining to their pastor or their minister or their, whoever it is. We're seeing and hearing this, and it's a powerful dynamic, and I think that it matters in terms of thinking about how we try to address this problem.
I just want to say, I talked to one lady who had gotten in deep on some payday loans, and I asked her if she had made any complaints. She said no, because she feels so stupid that she let herself get into the situation. But when I talked to her, she wasn't stupid at all. She was just, trying to make $1 out of 95 cents. It was just a tough situation, and she was being taken advantage of. And much of the money she had to reborrow to pay back the money she borrowed in the first place was really high in terms of fees. I wonder if you take my last minute to explain why it is that the alternative to good regulation in payday lending is not illegal loan sharking. You notice, you hear people say that all the time.
Yes, I do.
Could you rebut that, if you please?
Yep. The notion that you're going to drive people to further illegal conduct, that's not where most families are going to go. There hasn't been some huge uptick in loan sharking in the 13 states that have effectively banned payday lending. It's an interesting experience to see what the real experience has been in those states over many years now. But I do think we are trying to make sure that there is room for responsible lending, room for community banks and credit unions in particular, but others, installment lenders who are traditional and have responsible products. That it's a tough balance. That's why it's been a difficult rulemaking. We've been at it quite some time, and we're still hard at it. But we're trying to, again, the voices in the room from the faith community have altered the dynamic in powerful ways. We encourage those voices. We want to hear more from them on this.
Time of the gentleman has expired. The chair now recognizes the gentleman from Arizona, Mr. Schweikert.
Thank you, Mr. Chairman. Mr. Director, little hopping around here. you had a bit of the discussion about data. What of the data sets? Because, you know, the news stories have been that, you know, they're pretty stunning in size and complication. Have you blinded, so you've removed the personal identifiers and made that data public? So if I'm a researcher, if I'm a left-wing researcher, right-wing, or just an academic, someone doing their post-grad, I have access to this publicly financed collection of data to understand trend lines.
Yeah.
What is available to the public?
So we typically have worked to anonymize or de-identify data before it comes to us, because I don't need to know that it's you or it's me.
And
we're not
there's
interested in that.
directives from the
in
White
the
House
private sector, they're very
how to do
interested
it.
in that, and they're marketing against us all the time. But that's not what we're doing. We're trying to monitor the market, not the individuals. So that's important. But the second point to your question was what again?
Well, my great interest is, as you're creating public policy, ultimately what you're doing, and we're having these sorts of discussions, it would be neat to have a fact-based, data-based discussion, because you said something very early on, and I don't think you meant to, that sometimes the data is in the eye of the beholder. It's not. The data is the data is the data. It's
That's
the noise
the assessment of the
within
data is what I meant to say. Yes,
and
good point.
I'm sure that's not what you meant, because you've gone out of your way to say you're a data-centric agency. Well, then we all deserve to touch the data and model it and stress it and match it against other data sets to see if it's saying the same things you're seeing.
So wherever we can, it's our principle that if we can make the data more publicly available to everyone so they can see for themselves and judge for themselves, and maybe they see things that we didn't think of, and maybe they see things that refute things that we thought of.
Or other paths for better policy. I mean, sometimes it's not got you. Sometimes it's, hey, when we matched it against this, did you see this noise?
So first of all, that reinforces, as you make the point, the importance of the data. And then where we can make it public, the HMDA, the Home Mortgage Disclosure Act data is public. We've worked on better tools to make that more accessible.
But you have some massive trendline data and regional data and even some, my understanding, it's broken out demographically, with ethnic tags. Please make that as public as you
where we
possibly
can. Some of it is proprietary data that we purchased. We don't have the authority to make it public. Some of it is supervisory or enforcement data that is confidential. But wherever we can, our principle is to try to make it public so that everybody can make their own judgments about it.
And just as one policymaker, I have great concern of proprietary data making public policy, because when the rest of us cannot sort of stress it and see it and match it and test it, there's something almost unseemly of, well, we bought this data, but we have a non-disclosure on it, but we're going to make rules that affect your lives. Just understand, I think that's a bad direction.
Got it.
Sorry, and this is maybe a future conversation. Your faith groups. Quick anecdote. It's 20-some years ago. We had a check cashing issue. I've already pitched you on this once before, where the fees were outrageous in my community. And guess what happened? A couple of my faith-based groups actually set up little windows at their church and this, and they were cashing checks for a minimal fee. And then some of our local regulators say, hey, why don't we give check cashing charters to anyone that wants it? The Circle K, the 7-Eleven, the church, this, and the fees crashed. If your faith-based groups care about this issue, how do you promote them to also step up and participate in those low-dollar short-term loans? And that's the next step. Back to the data sets. Do you have data sets that say, hey, here's an incredibly competitive market where lots and lots of players of different groups are participating in these low-dollar short-term loans, look at their cost structure, compared to areas where we've set up so many regulatory barriers that only a handful get to participate.
I have a lot of the same instincts you do. Maybe it comes from having both been in public office as treasurers at the local level. I've always been puzzled as to why other lenders don't compete down the high costs of these payday loans, the 390% interest rates and the like. It doesn't seem to happen, and that's a puzzle to me because it feels like that's at odds with the natural workings of the marketplace.
Because we heard our member from New York allude to saying, hey, and you actually said the online, some of the dodgier access to these short-term, isn't the ultimate solution here actually the market itself? allowing many actors and players to participate in that line of business?
I might have thought so, but it's been 20 years and it hasn't been
Well,
happening.
maybe it's time that you come up and promote a simplified charter.
I'd
With
be
that,
glad
I
to,
yield
glad
back,
to
Mr. Chairman.
talk to you and work with you on that.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Ohio, Ms. Beatty.
Thank you, Mr. Chairman, and thank you, Director Cordray, for being here today. Let me first say that I am proud to associate myself and my comments along with what Congressman Al Green stated about President Obama and his appointment of you. Today, I join my colleagues in congratulating you on many of the successes. As we talk about students and those entering college, I thank you for the actions against the Corinthian College chain. Also, I think worth repeating, $11 billion recovered for some 20 million American consumers. And more recently, the actions that your office took against an Ohio bank for discriminating against African Americans with credit cards. But let me say this, I have asked every director who sat in that chair a question about Section 342 of the Dodd-Frank Act, OMWI, the Office of Minority Women and Inclusion. And I do that for several reasons. For more than 2 decades, I traveled across the United States as a diversity consultant with private corporations and with government. But also, I think it's important for people who look like me to have someone who is standing there advocating for them. And my role is to protect the institutional consumer and the individual consumer, just as your role is. So the question that I've asked everyone is to address what attention and actions that they've taken as it relates to OMWI. And I think that's very important with you because we've heard about the data, the surveys. We've all read the American Bankers Report of 2014 and 2015. And you kind of have a mark against the culture of your operation as it relates to fairness in pay for women and African Americans. And then, so I want you to answer what you've done. I noticed most recently you've appointed a director to report directly to you.
Yeah.
That's good news from where I sit, and I'm going to thank you in advance for that. And the second thing I want you to answer is most recently in the joint ruling where you can report your diversity either on a voluntary basis or it could be mandatory. Talk to me about the differences and if you think that people will fairly report and accurately report, and what you think about it being available to the public. Because clearly we're gathered here in this hearing because we all have a concern. Those concerns might be a little different depending on what side of the aisle you sit on.
Yep.
But if you could address that for
Yep,
me.
sure. And I've always valued, as you know, Representative, your insight into this because you have spent years as an expert in the field dealing with lots of different workplace settings and having a sense of how they different. I remember when we worked together on financial education at the state level, you brought a perspective of how that affects different communities in a way that was very valuable for us. So for us, in terms of the issues within the Bureau itself that have been very real for me and of great concern, there's both procedure and their substance. And the procedure, you know, in terms of things like elevating our OMWI, et cetera, and showing our concern, that's one thing, and we've been doing that, and that's important. The other thing is substance. So the performance management system was the root of a lot of this, and we have thrown it out. And we're working with the union to overhaul that in a way, and the number of complaints people have diminished significantly accordingly because they're not having that problem that many of them were reacting to. In terms of pay, there have been pay equity issues at the new Bureau, partly because we were in a hurry to start up and things you couldn't always put them on a grid, and we found later that some of it maybe was not as it should have been. So we've adjusted a lot of pay equity grievances and complaints as well. I don't know that they correlated by race or gender. I don't believe they did, but we've been working to correct those wherever they lie. And in terms of the OMWI in terms of the standards and the other agencies. We're trying to work hard with the other agencies to bring the spirit of OMWI, which Ranking Member Waters has really impressed upon me, into our agency and to the other agencies. And then also to push on, and this is where, again, you have perspective, how can we push on the financial services industry to itself become more diverse and to recognize there's a huge opportunity here with their broad consumer base, which is itself becoming more diverse. If you don't keep up with it, you're going to fall behind the times in terms of your business success. So
I'm going to have to stop you because my time is up, and I want to end with saying to you thank you. One, we've hit you with some hard questions.
That's always fair.
But I want to say to you that I like your words that you said, I want to do better.
Yep.
And so we will help you do better.
Thank you.
Thank you.
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of our Oversight and Investigations Subcommittee.
Thank you, Mr. Chairman, and welcome, Director Cordray. Obviously, you are a very smart man, and you are working, I think, diligently on what you would argue is the protection of consumers. We might disagree on how far you've gone or what you've done, but I do think you're trying to do the best that you can. I have a couple questions for you, and I know we're getting late in the day, and I just ask you for, I think they're pretty simple questions, and they're yes or no questions, or if you don't know, you can tell me that too.
We'll try it. It doesn't always lend itself to that, but I'll try.
But I think this will, and hopefully with our limited amount of time, you'll just give me yes or no's. So with that, have you ever advised senior CFPB staff or attorneys, or been advised by a senior CFPB staff or attorneys that eliminating dealer reserve either is or should be a goal of the CFPB?
I think that early on we thought that that might be one of the solutions to the problem. We never said the only solution to the problem. I think we've moved in the direction of thinking that limiting the reserve might be a satisfactory solution.
So you were advised by senior staff that you should look at eliminating dealer reserve? The answer to that is yes?
So what I would say is, on an issue like that, we debate lots of different alternatives.
So the answer is yes.
So undoubtedly, so I would say yes, at some point in that discussion, some people advocated that, others advocated other things.
So
it doesn't mean that was the policy of the Bureau.
That wasn't my question if it was a policy. You were advised in discussions that about eliminating dealer reserve. So the answer is yes, you were.
Some people thought that was the right answer, others didn't.
Okay. Let's not do this. I think I'm not asking you whether some people thought it was good or bad.
I think I've answered your question.
I think you have too. Have you ever met with senior CFPB staff or attorneys to discuss eliminating auto dealer reserve? The answer to that is yes, right?
That was one of the possible solutions to the problem, not the only solution.
So the answer is
yes.
yes.
There were discussions of that.
Okay, great. Have you ever discussed with senior CFPB staff or attorneys any strategy for eliminating dealer reserve? So have you talked about the strategy on how you would do that?
I think that follows from your earlier questions. I believe that that's so.
So you talked about the strategy, okay. Have you ever discussed with senior CFPB staff or attorneys ways to encourage indirect auto lenders to eliminate dealer reserve?
Auto lenders, yes. I would say yes. Mm-hmm.
Has CFPB staff or attorneys ever advised you that they were considering rulemaking as a way of potentially banning dealer reserve?
That was one of the alternatives, yes.
Okay. And obviously you did not go for that alternative, correct?
Beg your pardon?
You didn't go with the rulemaking. You went for enforcement, right?
I would say we haven't ruled it out, but we haven't done that yet, obviously.
Okay. Have you ever met with senior CFPB staff or attorneys to discuss the impact that a market tipping settlement or settlements would have on auto lenders?
I think we have considered that from time to time, yes. Mm-hmm.
Have you ever met with senior CFPB?
Say we still think about that, yes, quite a bit. Mm-hmm.
Yep. Have you ever met with senior CFPB staff or attorneys to discuss the risks and benefits of publicizing the proxy methodology that the CFPB is using?
I've always been in favor of us being as public as we can about our approaches to these issues. And again, our approaches are similar to those of other agencies and the Justice Department.
Now let's try my question. Did you guys, you and the senior CFPB staff or attorneys, discuss the risks and benefits of publicizing the proxy methodology?
Okay. So we did publicize the methodology, and therefore we would have assessed the risks before doing so, yes.
Okay. You approved the CFPB settlement with Ally Financial, correct?
I did.
And isn't it true that in the Ally matter, the statistical model used by the CFPB to determine whether there was there was disparate impact, I'm sorry about that. In the statistical model that you used to determine whether there was a disparate impact, you excluded creditworthiness as a variable, correct?
I don't recall exactly what the components of that were. That may be correct, that may not be correct. I don't, as I sit here, I don't have a
Is it your testimony that it's possible that in the Ally settlement that you reviewed that you did consider creditworthiness?
I think we have always tried to include the components that relate to creditworthiness in the statistics and not exclude those.
So I'm talking about the Ally, that's my time. In regard to the Ally settlement, did you consider creditworthiness?
We typically have regarded that. What we've tried to wean out is the prohibited characteristics and factors that would be violative of the Equal Credit Opportunity Act.
We didn't talk about what you do typically. I'm asking you specifically in regard to the Ally settlement, which you approved, did you consider creditworthiness as a variable?
I believe that our methodology attempts to take account of creditworthiness and other non-discriminatory factors in order to then weed out the discriminatory factors.
Mr. Chairman, I would just note that I would note my time has expired, but I would ask to be recognized for an extended question period as permitted by the committee rules.
Pursuant to Clause D4 of Committee Rule 3, the chair recognizes the gentleman from Wisconsin for an additional 5 minutes.
Thank you. So I want to be clear. You did consider creditworthiness in the Allied settlement?
I don't recall now, a couple years ago, exactly what we were doing at the very moment at which we would have reached the resolution there, but our models typically are trying to take account of creditworthy types of issues for the customers and weed out the discriminatory
is it your testimony that you don't recall whether you, when you...
I'd be happy to work with your staff to give you
So you have no independent recollection right now whether that was taken?
I don't have any specific recollection of. I'm not sure when you say creditworthiness whether you mean there's something specific or whether there's a number of factors that bear on that, which is how I would regard it.
Specific or broadly. We can go either way.
Yeah, I'm happy to follow up with you on that.
Did you ever discuss with or receive inquiry from the CFPB staff or attorneys regarding the possibility of accepting any controls proposed by allies, such as creditworthiness of borrowers in your disparate impact analysis in an effort to settle the case?
I'm sure that there were discussions of that back and forth.
Okay.
I don't tend to myself be involved in the details of the settlement discussions. I leave it to the team that's negotiating that, but I'm sure that would have been raised on both sides and there would have been discussion of that.
But in your internal discussions about the Ally case, isn't it true that the CFPB staff advised you that there was a correlation between an applicant's trustworthiness and his or her dealer reserve? You were advised of that, weren't you?
Say that again?
So you were advised by the CFPB staff that there was a correlation between an applicant's creditworthiness and his or her dealer reserve.
So a moment ago you answered the question, you said trustworthiness. I wasn't sure what that
I'm sorry, creditworthiness.
Creditworthiness and dealer reserve. There probably were a lot of discussions and that may have been something that was raised. I can't remember a specific conversation, but.
Okay, so you're not aware of whether you were advised about the correlation between creditworthiness and dealer reserve?
Again, when this gets into negotiating some of the details of a resolution, the team will work with the institution on that and with the Justice Department, who is a three-cornered party in those discussions. Okay?
This goes to Mr. Scott's point, though, doesn't it? That you have a factor like creditworthiness that factors into disparate impact and the dealer reserve, and you're not considering it.
No, that's not what I've said. That's not what I've intended to say.
So I want to be clear on your
What I've said
testimony.
is, when you say creditworthiness, you may think that that's like my size, which is 6'2", and it's a firm, clear fact. I think it's a set of characteristics and a set of criteria that may vary depending on, Ally might have had a view of what goes into creditworthiness. We might have had a view, the Justice Department might have had a view.
Per the CFPB's analysis, did you look at creditworthiness? Do you have your own, not mine, no one else's, but Director Cordray has a view of what creditworthiness is, and you applied that to the Ally settlement?
Look, I think generally creditworthiness is a fair consideration when people are making a loan. I believe that we try to find ways to take appropriate account of that in our
Right.
approach to these issues.
And it can account for the differential in the dealer reserve, which your staff told you.
Well,
right?
That would be one of the points of contention that people would have.
Or
I mean,
did they not tell you? Did your staff not advise you of that?
No, again, it wouldn't be whether creditworthiness itself is on or off the table so much as what kind of factors bear on that and which ones are relevant and which ones are not. And again, somebody like Ally and us and DOJ may have different views of that, and we try to work them through and talk them through. I mean, it's just not quite as easy as a simple, on-off switch on creditworthiness. I don't know how to, I'd love to just do yes or no with you on this, but it's fairly complicated.
I'd love that too, but
Okay.
and just my last 50 seconds.
Mm-hmm.
I think that it's important that when your government makes rules, whether it's in this institution or at the CFPB, they're very clear.
Mm-hmm.
And so when you're advised that you can actually do a rulemaking in regard to this issue, and you choose not to, but you try to make rules by way of enforcement,
Yeah.
people don't know what the rules are. So the heavy hand of the CFPB comes bearing down on an institution, making claims of racism, and if you think this is so important, why wouldn't you do a rule? Why wouldn't you let people offer comments? Why wouldn't you give guidance?
It's a fair question. The tool-making choice for us is a difficult choice. Where we think a matter is going to involve more in terms of specific facts and circumstances,
How do you this?
it's
My-
harder,
my- my
it's
time
harder
is up.
for us to write a rule at the outset. We want to get more experience with that. That's what we've done here. You may think in retrospect that wasn't the right answer. Maybe years from now I'll look back and think it wasn't the right answer, but that's how we've tried to proceed.
Time of the gentleman has expired. I ask unanimous consent that the gentleman from Texas, Mr. Green, be recognized for 5 minutes. Without objection, the gentleman is recognized.
Thank you, Mr. Chairman. Mr. Cordray, are you a lawyer?
Am I a lawyer?
Yes, sir.
I am. I haven't really been active in practice for a while, but yes, I'm
Yes,
a lawyer.
sir. And as a lawyer, do you understand that a settlement is an agreement?
Yes, it is.
And an agreement, by definition, means that parties have reached a conclusion that they find themselves amenable to, such that they can go forward with that conclusion. Is that a fair statement?
I think that's fair. Doesn't mean they all agree with each other on all the subparts, but yes, I think that's fair.
And is it true that in the Ally case, there was an agreement, a settlement,
Mm-hmm.
and that, which means that the offending party, this is my terminology, agreed to certain penalties and certain payments such that this could be resolved and such that persons who had been harmed could be justly compensated.
And notably also certain changes in their practices going forward, which may be more valuable in the long run than the payments made.
But the gravamen of my contention and the gravamen of this discussion is agreement.
Mm-hmm.
This is not something that the party who has now found itself in a position to make these payments, is not something that the party refused to do, refused to sign, said, I won't deal with you, take me to court, I don't want to cooperate with you. There was a certain amount of cooperation in this. Is this correct?
Yeah, could have done that, and they didn't.
They did not. And here is what I find from my review of some intelligence. The CFPB and the DOJ determined that more than 235,000 minority borrowers paid higher interest rates for their auto loans between a certain period of time, April 2011 and December 13, because of Ally's discriminatory pricing system. Now, this is not something that Ally had to acquiesce to. This is something Ally chose to do for whatever reasons. It chose to do this. And by the way, Ally is not without a battery of lawyers. Is that a fair statement?
That's a fair statement.
And their lawyers, I assume, are capable, competent, and qualified persons who could easily decide that this is better suited for litigation than for some sort of settlement resolution. Fair statement?
I think so.
So, I see in this the largest ever settlement in an auto loan discrimination case. I see this in this an opportunity for us to send a message to others that if you discriminate, we're going to come after you. This is lawful, it is ethical, it is righteous. People who discriminate ought not be allowed to do so with impunity. And others ought to get the message that if you do it, you too will have to pay a price. I find very little to complain about with this decision because the party paying agreed to make the payments, agreed to this settlement, which, by the way, is large. But when you do a great amount of harm, you should pay a great amount in penalties. I'm showing here that 18 million in civil penalties were agreed to. So, Mr. Cordray, if you have a conversation about your options, is that in some way unethical if you talk about options in rulemaking? My assumption is that you would look at the entire range of options when discussing rulemaking. Is this true?
I don't think we could act responsibly if we didn't discuss all the options and then try to make our best decision, which may or may not be the right decision. Somebody else might disagree, but yes, we talked through the options. And I don't think there's anything wrong with that, and I think it's the right way to proceed.
And in talking through options, do you sometimes talk about options that the industry might not find favorable?
Sure.
Do you also sometimes discuss options that consumers might not find favorable?
Yep, I'm sure that's the case.
But that's your duty.
Yeah.
I yield back the balance of my time.
Chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Very quickly, just to follow up, Mr. Cordray, you all had a little bit of leverage over Ally, though, didn't you? It wasn't exactly a typical negotiation. They needed Federal Reserve approval, didn't they? They needed approval from the Fed that your deal was settled with them? That was leverage you had over them you wouldn't have over other folks.
So I don't put it that way. What I would say is this. We pursued an auto discrimination matter.
It's true, and it's not my line of questioning. I just want to follow up, Mr. Reed. They needed to have a deal with you in order to get Fed approval. In fact, they got their Fed approval 4 days after their deal with you, right? Do you think that factored at all into the negotiation?
Here's what I would say. That's what they wanted, okay?
Right.
We had an open discrimination matter against them that they were resistant to resolving. Then suddenly they decided they wanted to resolve it. That's their choice. That's not me.
That's fine. Let's
I
talk
didn't
about
create
that
the leverage.
discrimination.
I didn't
You mentioned
set that up.
something
Yes.
before with Mr. Duffy about creditworthiness, that you have your measure and that DOJ has theirs,
Yep.
and Ally might even have theirs.
Yep.
I buy that. Y'all didn't use anybody's creditworthiness in your statistical model on Ally, did you?
I don't believe that that's the case. And again, it's not so easy to say creditworthiness like it's a specific packaged fact.
But y'all have a measure of
criteria
creditworthiness, right? Let's use credit score. Did you use credit scores in your statistical analysis of the Ally case?
I don't believe we did, but
why not?
Well, there are a lot of things we could do, whether they're
Well, I recognize the fact that creditworthiness may have a lot of different pieces and parts to it, but it would strike me that everybody would agree that credit scores would be part of creditworthiness,
Yeah, although,
wouldn't it?
look, there's a lot of financial institutions we've seen that don't use credit scores as the right indicator of credit.
Do you use it in your analysis?
No, I'm saying, for example, the FICO score is known as that's
Sure.
the most well-known credit score.
Right.
A lot of banks have moved away from that. They think it's too crude, and they have more nuanced approaches to creditworthiness that they think are more refined and better from their standpoint. So again, creditworthiness is a more elusive concept, and just to say credit scores equals it is not.
So coming back, using whatever definition of creditworthiness that you want to use, did you use a creditworthiness analysis as part of your statistical model in the Ally case?
I think we try to use criteria that we think will account.
Didn't ask you about that. Ask you what you actually did.
I'm saying that that's what we try to do. Now, whether
Mr.
that
Cordray, listen, we could do this all day because I'll get 5 minutes. I'm not asking you what you tried to do. I'm simply asking you a straight question. Did you use creditworthiness, however you want to define that, in your statistical analysis of the Ally case?
I think we use factors that try to reflect that aspect of the transaction.
All right.
Yes. Ally might disagree. You might disagree.
It's fine. Listen, I'm sure there's lots of things we disagree on, but I'm actually trying to find what we agree on. Did senior staff or your attorneys ever tell you that your disparate impact methodology will at times overstate disparate impact?
I think there's always a risk that any methodology might either overstate or understate.
I didn't ask you that question. I asked you if your people told you that.
One of the things you're trying to do is to get it as right as possible. And depending on whether if you compare it to the mortgage universe, it might seem to overstate. But that we don't think is the accurate comparison.
Wonderful. Does your methodology at times overestimate disparities?
We don't intentionally overestimate anything. We try to get it right.
How about unintentionally? Okay, you
try
try to get it right. Do you ever get it wrong?
Whether sometimes, I think we may, sometimes over, sometimes under. I'm not sure that it's systematic either way.
All right, did senior staff or your attorneys ever advise you that the Bureau had evaluated an alternative methodology for estimating racial disparities to the disparate impact analysis, and that this alternative methodology reduced the disparities for several racial groups, including African Americans and Hispanics?
I think we've seen different methodologies that can lead to different results. Some of them we think,
I'll take that one as a yes.
So I'll just say some of them we think are illegitimate. Some of them we've decided there may be different reasonable approaches to this that may differ from one another.
Did your attorneys or staff ever tell you that they thought you had serious litigation risk in the Ally case? And
Say
that
that
they
again?
did your senior staff or attorneys ever tell you they thought you had serious litigation risk in the Allied case and that they wanted you to seek pre-litigation settlement?
I think we have litigation risks every time we pursue a matter.
Gotcha. Didn't ask you that question either.
So I would say we had that risk in Ally. We have it in every matter.
Okay.
And it's something that we have to take account of and think about. And so does the institution, by the way.
In my last 30 seconds, I want to follow up on something Mr. Ellison said. Your own database, your complaint database, shows that payday loans are one of the least complained about financial products. And it's the only product I understand has an actual year-over-year decrease in the number of complaints from 2014 to 2015. So if people aren't complaining and you haven't brought to us any peer-reviewed studies saying that it's actually a problem, why are you considering rules that will dramatically reduce short-term small-dollar credit to people who need it?
So what I'll tell you is in the last year, the voices of the faith community who hear these complaints from their congregation members have gotten louder. And I would love to have them come and visit you and tell you what they see and hear among their congregations and their parishes and in their synagogues and in their mosques, because they are very concerned about this problem, and I found their voices to be powerful. And I'd like you to hear those voices as you're assessing.
You know what?
this kind of
I'll
issue.
do that just as soon as the lady down the street, down the hallway today on Planned Parenthood will listen to the faith community about funding Planned Parenthood and abortion. How about that? Is that a deal?
I don't have anything to do with
I can't believe you just told us you're making decisions based upon meetings with the faith-based community when, on a selective basis, but we'll leave that for another day.
Wait a minute. Wait a minute.
Time of the gentleman has expired. The chair
All right,
now
I'll let you-
recognizes the gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Chairman. Director Cordray, welcome back to the committee. And I'd first like to just take a little issue with your testimony about the relative health of the mortgage market
Yes.
and the recovery that you cited. And you cited federal agency data, and in particular, Home Mortgage Disclosure Act data.
Yeah, everybody agrees that's the best data around.
Well, I
Yeah.
understand, but the data is at least mixed, because the National Association of Realtors reported that in the first quarter of 2015, which appears to be pretty recent data, only 1.2% of originated mortgages did not fit the definition of qualified mortgages. So there's at least a fear of liability in terms of originating non-QM mortgages, which I hope the Bureau would recognize. And
So, but can I say a point on that? Point on that?
I'll let you,
Okay.
I want to just finish my point real
All
quick,
right.
and then I'll be happy to let you respond. Other part of that data is that a third of National Association of Realtors survey respondents reported being unable to close mortgages due to a requirement of the qualified mortgage rule. And what I'd specifically like for you to respond to is maybe the explanation for the health in the data that you're citing is because of the GSE exemption. The problem with the financial crisis was the originate to distribute model. As you know, I'm promoting a portfolio lending model which would encourage risk retention, which was a core policy of the Dodd-Frank Act. The GSE exemption, which is the reason for the relative health in the data that you're citing, is exactly why we got into the mortgage financial crisis to begin with. Originate to distribute to Fannie Freddie. That's why your data conflicts with the National Association of Realtors data. You can respond.
No, I don't think it conflicts at all. What in fact you're seeing is that mortgage lending is up for home purchase mortgages. What varies in the market, of course, are refis. Those go up and down with the interest rate, so you can't really say much from that. And in terms of the legal risk being so prominent from the qualified mortgage rule, I met with the Mortgage Bankers Association recently, the top CEOs of mortgage units, top 40 companies. I asked them specifically, have any of you had a single lawsuit on the qualified mortgage rule? It's been 21 months now, 21 months. A single
Right, well,
lawsuit, not one.
Understand, but
not
if they're
one. So all this,
if they're in the safe harbor,
all this foaming at the mouth about legal liability, really did not pan out. It was an overreaction.
Director, I understand if you're in the safe
Overhype.
harbor, you're not at risk. The point is that access to mortgage credit is not available if you're going to portfolio a loan right now, but there is a safe harbor if you sell it to Fannie and Freddie, which is how we got into the problem in the first place. So the policy is counterproductive, in my opinion, not only in terms of constraining access to responsible mortgage credit that is retained by the institution, but you're actually incenting, with the GSE exemption, the kind of risky practices that caused the financial crisis. I do want to get on to
I see the
Fred.
point, but two things. Number one, while they're in conservatorship, which this constraint, very significant. Second, we've just expanded the ability of smaller institutions, community banks, credit unions, to do more portfolio lending, which I agree with you, I think is very positive, and I think they think is very positive.
But it doesn't do what my bill would do, which would be allow a petition process. Let me get to TRID real quick. As you may recall, Congresswoman Maloney and I and 252 of our colleagues sent you a letter on May 22nd requesting a grace period. We met. We asked if closing attorneys and realtors and title insurers could count on a grace period. You said they would be happy, but what happened the next day was that you would engage in a policy of sensitive enforcement, which gave, unfortunately, no clarity or, and I'm just telling you what my constituents are telling me, okay? I'm not opining, I'm telling you.
I'd like to clarify it today then for you.
I'm telling you what the closing attorneys are telling me back home in Kentucky. They're saying we're gonna have to do 2 closings, one with a HUD settlement statement and one that is TRID compliant, which doesn't decrease the amount of disclosures that are going to be required for the homeowners and home buyers to actually review. It's not a simplification. The question is, we're still trying to get this right. All we want from the Bureau is not just a promise of sensitive enforcement, but a grace period, a transition period. And the question for you is, are the closing attorneys, the realtors, the title carriers, can they count on you to not bring an enforcement action for a period of, say, 6 months while they're trying to sort through the complexity and trying to get up to speed?
Look, I don't think it's appropriate for me to say I won't enforce the law when my job is to enforce the law, but I think what I have said says to them that we're going to be diagnostic and corrective, not punitive, in that early period. I think if they read between the lines, they'll understand that we're trying to allow them to have the latitude that they have asked for. And I think people should be able to take yes for an answer on
With
this.
my remaining time on short dollar loans, one of my constituents testified, small business owner, that she was going out of business as a result of your proposed rulemaking here. In Kentucky,
So what kind of person?
A small dollar lender, a payday lender. The Attorney General of Kentucky, the Democratic Attorney General, the Democratic Governor, and his financial institutions department, and the Democratic General Assembly in Kentucky all reformed our payday lending and usury laws. Why don't you trust the Kentucky Democrats who have put these rules into place? What do you know that they don't know?
To me, this isn't a Democrat or Republican issue. That's not the way I look at things.
I understand.
There are different states that have different approaches, but if you look at it on a national basis, there's a ton of rollovers, there's a lot of consumers in a lot of trouble. By the way, last time I was here, you asked me about Bath County and Kentucky.
Right.
Under our new provision, it's all rural.
I appreciate that. Like other counties to be able to
Time of the gentleman
Thank
has
you.
expired. Time of the gentleman has expired. The chair recognizes now the gentleman from Colorado, Mr. Tipton.
Thank you, Mr. Chairman. Director, according to Treasury's website, over 5 million recipients have enrolled in the Direct Express program, which is used by the federal and state governments to disperse supplemental security income and Social Security benefits to those enrolled. According to the U.S. Treasury, it costs $1.03 to issue a paper check, only 10.5 cents to be able to use the electronic payments like Direct Express. Yet the CFPB has proposed a prepaid account rule that would fundamentally change how government cards, including a statement at the top, to require disclosure to all recipients that the recipient does not have to accept a government benefit card. And I guess my question is, this has been popular, seems to have worked. Does this new policy, is this going to create some disharmony and actually disincentivize people from being in the program?
So I have the same reaction you do. I think that the fact that government programs at the federal, state, and local level, county, city, have moved toward benefits on cards as opposed to issuing paper checks is beneficial to consumers in many ways. I don't think our prepaid card rule is affecting those government programs, but if it is, I'd be glad to have our folks follow up with your staff and make sure that we can give you assurances in that regard. And if it is a problem, then we still have that rulemaking pending. We could take account of that as we finalize it. So
Good, I'd
be
appreciate
happy to have
I
that
think,
discussion.
Yeah, 95% approval rating with those government cards that's going out.
And it's more secure, better for the consumers. They don't have to deal with cash or check cashing and other things. I agree with that.
Yeah, and Director, the proposed rule for prepaid accounts has raised some serious concerns over the treatment of credit features for prepaid products. Consumers are using these products, obviously, to be able to meet their everyday needs. In my own district in Colorado, we have Dolores from Pueblo who wrote that the prepaid card helped her put food on the table for her family or to be able to pay a utility bill. And I'm concerned that the lack of understanding of how this product is used by folks back at home will lead to its elimination. And what's the CFPB's plans to be able to make sure that consumers, or like Doris in Pueblo, continue to have access to overdraft protection?
So in terms of prepaid cards, the rulemaking that we have underway, and it's still pending, so it's not final, is intended to create consumer protections for those cards that have never existed. I think people reach into their wallet and they get out a debit card or a prepaid card or a credit card. They assume they have the same protections. They don't. Prepaid cards have nothing. If you have errors, you can't get them corrected. If you have disputes, you can't get them resolved. You have no rights in that regard. So that's been the focus of our rulemaking. In terms of overdraft on the prepaid cards, what we proposed in our initial proposal that we're still working through and thinking about was that those cards should be treated similar to credit cards in terms of whether they are credit or not, if they involve overdraft. And that was the proposal. We've gotten a lot of comment on that both ways, and we're working through that.
Okay, and just making sure that that is available, I hope that you are taking into consideration that the concern this creates in terms of the industry have almost unanimously noted that they'll stop offering overdraft features with some of the proposed
By the way,
restrictions.
very few in the industry offer overdraft now. Almost unanimously, they do not offer overdraft. So, I mean, it's a very small portion of the industry that this would affect. But the proposal, at least, was to offer such people credit card-like protections, like in the CARD Act. You know, we've seen both criticism and endorsement of that, and we'll have to size that up and
okay. Well, Director, I'd like to go back a little bit to the conversation that you're having with Mr. Rothfuss and Mr. Schweikert in regards to some of the data that is coming out. The government has suffered, obviously, some very embarrassing security and privacy breaches recently and lost sensitive data for millions of federal employees. And CFPB is about to issue new Home Mortgage Disclosure Act rule, which will require lenders to be able to submit detailed private information on their customers. With that in mind, can you specify what steps that the Bureau is taking to be able to protect homeowners from data breaches?
yes, that information for our National Mortgage Database, if that's what you're referring to, will be de-identified and anonymized before it comes to the Bureau. And that's exactly how we're trying to handle it. And therefore, I think it's of little interest to hackers because they would have to, as the Congressman was mentioning earlier, they have to go through an arduous re-identification process if they even could do it, as opposed to other databases that companies have where if they can hack into those, they can get right into personal information and the like. That's how we're trying to handle that. It's been looked at by the GAO and the Inspector General. I think it's a responsible approach. If people have further suggestions on it, I'm glad to hear them.
Yeah, the U.S. Chamber of Commerce put out a statement that the Bureau is putting consumer personal information at risk by collecting enormous volumes of identifiable information, yet failing to be transparent or install competence that has recognized and addressed the cybersecurity risks posed by such a vast amount of data.
Yeah, I don't think that's really accurate to the details of what we're doing. I understand the statement for rhetorical purposes. I'd be glad to talk to the Chamber about it. They have not raised the issue with us recently.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Williams.
Thank you, Mr. Chairman, and thank you, Director Cordray. I'm a small business owner, have been for 44 years, and I'm a car dealer.
Yep.
And I stand up, my colleague, Congressman Green, I stand up for customers every single day. You're not the only one that stands up for customers.
Yep.
Now, I want to go back to Section 1029. We talked a little bit about it today, but let me read what it says. The Bureau may not exercise any rulemaking, supervisory, enforcement, or any authority, including any authority to order assessment over a motor vehicle dealer. That's me.
Mm-hmm.
And this is predominantly engages in the sale and service of motor vehicles, the leasing and serving of motor vehicle, or both. Now, I'm kind of new to this committee, but I'm not new to the automobile industry. My family's been selling cars for over 70 years, and we've done a great job, and we've taken care of a lot of people.
Yep.
But I think you and just about everyone here knows that. Now, I know we've talked about this issue a lot, so there's certainly a lot to talk about when it comes to this topic. We can talk about the flawed data we've talked about today used to claim desperate impact, or the fact that we've established the auto dealers are exempt. They are exempt from the CFPB supervision, or the way in which you released your auto finance guidance in 2013, or even how your agency has paid out claims to discriminated customers with little oversight. But I wanted to take this time today instead to educate you a little bit on what it means to be in the retail industry, what it means to be a small business owner in America today, what it means to be an auto dealer, and quite frankly, what it means to be a small business owner on Main Street America. My family business employs about 150 people. Just like any retail business in America, the cost of owning a business is not cheap. We have to worry about paying our employees, our utility bills, our credit, our debt, and making sure we have plenty of inventory for our customers to choose from. Now, if I sold every car at your price, at the wholesale price, which is what I think the Bureau would like me to sell it at, I'd be out of business in no time.
I wouldn't like that, by the way.
Well, you're not given that opinion. But you know what? I have to make a living. Frankly, I have to be profitable. I have to provide for my family. I have to take care of my employees. No business in America should be told by the federal government to sell their product at a given price.
Mm-hmm.
I think you know this. I really do. I think you really believe this.
Mm-hmm.
But the financing part of buying a car is just one piece of the equation. Right. Other factors include what the borrower pays for the vehicle or what the trade-in value they receive. Every deal is different. No two are the same. But because of the jurisdiction of the CFPB, you have focused on this, on the financing aspect of purchasing a car, and I think it's obvious why. I think what your agency is trying to get at is forcing auto lenders to offer a flat fee to dealers. Is that what you're trying to do? I mean,
We've said that's one alternative, but it's not the only one.
Essentially, when you do that, you eliminate the dealer reserve.
No, I understand. We're not saying that's the only way. That's not our
If you do that, you eliminate the dealer reserve and ultimately telling me what I can sell my product for.
Mm-hmm.
So what we've seen with the Ally Financial, Honda Financial, and just yesterday, Fifth Third Bank, is to force them to change their pricing and compensation models, and in turn avoid stricter fines. But ultimately, you will put these dealers at a competitive disadvantage by capping rates and putting them out of business. In fact, some lenders have even told me personally that they are discounting or discontinuing indirect auto lending because of the CFPB's campaign and increased compliance risks. They're scared to death. In other scenarios, some lenders, as is the case of Honda Financial, have responded by overhauling their loan price in ways that will likely mean higher costs for some borrowers. So, Director Cordray, who does this hurt? If you think about it, it hurts the consumer. The very people you're trying to protect, you're turning back and hurting them. So real quickly, yes or no, we've covered a lot of questions. Are you really trying to eliminate dealer reserve?
So when we first came to this problem, and we've said that's one alternative, but it's not the only one as we've come to understand the problem better. So to say that we're simply trying to eliminate dealer reserve, that would be no, that would not be accurate. Okay. That is one alternative, but limiting it would be an alternative.
All right. Do you have an idea what to replace it with the dealers?
So what I would say is this.
Well,
if you set up a lending program where you're going to allow people to mark up rates and be financially incentivized to do so, and the consumer is none the wiser, we believe creates great risks of discrimination, all right? We want to try to minimize that and eliminate it as much as possible. Having said that, if the pre-existing regime allowed for a certain amount of discrimination, where some borrowers are charged more than others, and you eliminate that, some of the others may now be charged a little more. They were subsidizing discrimination previously.
Do you talk to dealers like me on how to have a better idea? Nobody's talked to me.
We were very careful about not going out and doing a lot of talking to dealers because we want to respect the line that Congress drew. Again, it's not a very logical line, but
the
that's
time of the
line
gentleman has expired. The chair wishes to
You
advise
bet.
all members
Glad
that
to
there
talk
are
more with
votes
them if they
pending
want.
on the floor. Regrettably, we anticipate clearing 2 more members before adjourning. Mr. Poliquin and Ms. Love. Mr. Poliquin is now recognized for 5 minutes.
Thank you, Mr. Chair. Mr. Cordray, thank you very much for being here. I appreciate it. Your organization was created about 5 years ago by Dodd-Frank. You have about 1,400 employees. And in that short period of time, sir, you're one of the most powerful regulators in America. You regulate companies that provide automobile loans and home mortgages, credit cards, student loans, and you reach into almost every family in America. Now, we all know that these departments and agencies throughout Washington have their inspector generals. Now, these are important functions to make sure at every organization there's no fraud or abuse or wasting of taxpayer dollars. You know, I have a list right here, Mr. Cordray, of 76 departments and agencies in the federal government. Each one of them has their own inspector general, except the CFPB. You don't. You share one with the Federal Reserve. Now, the Federal Reserve, as we all know, is involved with monetary policy and regulating banks as institutions. Your agency, on the other hand, is involved in regulating financial products that are sold to consumers. So can't we agree right now that your functions are so different that you deserve your own inspector general, sir?
So if I heard you right, you said 76 departments and agencies have their own inspector general.
That's correct.
And we're the only one that doesn't?
That's correct.
I don't believe that's correct.
Well, here's the list right here, Mr. Charge. Right
No,
here.
I don't think that's correct. I
Well,
think there's many
your
agencies
testimony
that
is you don't
share an
believe that's
inspector
correct.
general.
Right, that's your testimony. Okay, well, fine. I'll let you look it up just the way I did. And you'll find you're the only one. So my question to you is the following: Don't you think it
we'll
makes
get back to you on
Don't
that.
you
I don't
think it
think
makes
that's right,
sense
but maybe
for you to
you
have
are,
your own
but I
inspector
doubt it.
general?
All right.
Don't you think it makes sense for you to have your own inspector general to look over your shoulder?
So-
Such that the taxpayers know they're being fairly treated and that you are held accountable.
So I hadn't dealt with inspector generals till I came to the federal government. And state government, as you and I were, we had the state auditor who would look at us every year, and that was
You know,
appropriate and helpful.
the Amtrak's my time, not yours, sir.
Yeah.
Amtrak, the Postal Service, the EPA, the Peace Corps even has their own inspector general. You don't.
That may be. Look, that's up to Congress.
Okay.
Congress decides that. But
Okay,
you
let's
know,
move
we've been
on.
working
Let's talk about
closely
transparency. Let's talk about transparency, sir. In your own semi-annual report on page 132, you make it very clear that it's important to be transparent in your operations, and I happen to agree with that. Now, you told us 6 months ago when you came here that you were going to make sure you posted on your website all your vendor contracts. Well, we went to your website, and guess what? We didn't find contract. And if I'm not mistaken, you've contracted about $60 million for the next 3 years on management consulting contracts with a number of different firms. Where are those contracts?
So I believe that all of our contracts are posted on USA.gov, which is, I believe, what federal law requires, except for contracts with other parts of the federal government. And in the startup phase with Treasury, we had a lot of contracts with Treasury.
Okay, here's what I'd like to do,
itself.
Mr. Charger. We're going to get in touch with your office. I'd like to
That's
see
fine.
all those contracts.
That's fine. If
They're
there are
not
any
posted because
contracts that you
promised
think are not
they would be
posted as they
posted,
should be,
and it
I'll
was
be
supposed
glad
be
to try to
transparent.
take account of
Good.
that and fix that.
Let's shift gears here a little
That's
bit.
fine.
Thank you very
Okay.
much. You sit on an organization on a board called the Financial Stability Oversight Council, FSOC. You sit on there with Treasury Secretary Lew, the chairman of the Federal Reserve, and also the Treasury of the SEC, along with other organizations.
That's what the law
Now-
requires, yes.
Now, FSOC is responsible for determining which non-bank financial institutions are too big to fail, meaning if they get in trouble, then the taxpayers are on the hook to bail them out. Now, we have about $24 trillion in this country that are managed by pension fund managers and mutual fund companies and asset managers. And you know, if one of those mutual fund companies isn't performing well, an investor can call up on an 800 number, replace that account with another asset manager. So there's no risk to the market if one of those asset managers gets in trouble. Now, here's what I worry about. I'm sure you know a fellow by the name of Holtz Eakin. He's the former director of the CBO, which is a nonpartisan organization. And you've seen his study, I'm sure, 2014, that says if asset managers that handle the retirement savings, $24 trillion of retirement savings in this country, if those asset managers that pose no risk to the economy, if they get in trouble, if they come under the guise of the Dodd-Frank regulations because you folks designate them as SIFIs, then the rate of return long-term of those retirement savings will go down about 25%. Now, where's the compassion? We're supposed to help small investors. You know who I worry about, Mr. Cordray? I worry about a nurse in Auburn, Maine, or I worry about an auto mechanic in Ellsworth. They're putting aside $100 a month to try to save for their retirement, And all of a sudden, you folks have an opportunity to ding them by 25% of the long-term rate of return in their nest egg. So I want to see if you and I can agree on something today, sir. Can we agree that it is a bad idea for SOC to so designate pension fund managers, mutual funds, and other asset managers as SIFIs?
So first of all, FSOC acts as a body. I think they've indicated that they're
Your
reviewing and
responsibility is to
analyzing
make a
these issues.
determination
No
on
decision
these
has
SIFI
been made.
designations. Do you think it's a good idea or a bad idea to so designate them?
I don't know enough to jump the gun on any decision-making
Time
process.
of the gentleman
what I would
has
suggest you do is
expired. The
take
chair
a
now
vote.
recognizes the
Thank you,
gentlelady from Utah, Ms. Love.
Thank you, Mr. Cordray. Thank you for being here.
My pleasure.
I just have a quick couple of questions that are concerning to me and to constituents in my district.
Okay.
In the CFPB's most recent annual report, it was stated on page 131 that a critical part of making financial markets work is ensuring transparency in those markets. The CFPB believes that it should hold itself to that same standard and strives to be a leader by being transparent with respect to its own activities. So my question for you is, what has the Bureau done to make sure that the consumers know that you are tracking their credit card data?
So we're trying hard to meet that aspiration of being a very transparent institution.
Okay, so what have you done to have them to make sure that the customers know that you are extracting credit card data?
Okay, so first of all, I'm not tracking your data or my data or anyone's data. What we're doing is we're getting data that is anonymized and de-identified so that we can evaluate the market.
Okay.
How can I possibly fulfill my responsibility to Congress to give you a report on how the credit card market
Okay,
is
wait a minute. We're
working
going to get there.
if I don't
We're going to
have
get
data?
there. We're going to get
Okay,
there.
all right.
Do most Americans know? Do you think most Americans know that you're actually doing this, that you're collecting data?
Doing what?
Collecting credit card information. So when they're going and they're actually making those credit card, you're actually collecting data from
Okay,
their
so
credit card
I'm not
use.
collecting it the way a bank would be collecting it, where they're actually trying to assess what Congresswoman Love ate for dinner last night and where you're shopping and trying to market to you. I'm just looking at the overall patterns in the market that have nothing to do with you or me or anyone else in particular. I don't.
So you're saying that you actually do not collect data from individuals that are using their credit cards. You're not collecting that information. Is that what you're saying?
It's all de-identified so that I wouldn't.
I know that you're going to say it's
so
not
hold on. No,
identified,
I mean,
but do you
I just
believe
I
that
think that's
the
really important.
consumers have a right to know that you're actually collecting the data? It's really simple. I'm not trying to have a fight with you here.
Yeah,
I just want
don't know.
people to know what's happening.
I don't know is the answer to your question, but it wouldn't have your name on it, wouldn't have your credit card number, it
It
wouldn't have
doesn't
any
matter.
of the kind
Don't you
of data
think
that's
that my
sensitive.
information belongs to me? And don't you think that they have a right to opt out at least?
Many other federal agencies have had this data
I
for
know that
years.
you were
What's
going to
special about us?
I knew
why,
that you were going
why
to
do you
say
come
that.
after us?
Okay.
I mean,
Do you think it gives the American people comfort to know that just because other agencies are collecting data, that it's okay for you to additionally collect data? I mean, I think it's actually quite absurd to hear that other agencies are collecting data, collecting as much data also.
So answer me this. We're supposed to do a
No,
report to
actually-
Congress every year on the credit card market and how it's faring. How
Okay.
would we do that if we didn't have data?
Let me ask you a question.
How
Okay,
would
so
we
let
do
me ask
that?
you these questions.
Okay.
I'm glad that you led us down this
Mm-hmm.
path. Can the Bureau receive complaints about credit card companies?
Beg your pardon?
If there is a company that is out there that is a terrible actor in the market, can you receive complaints about credit card companies if they are taking advantage of consumers?
So can we, the CFPB, receive complaints about credit card companies?
Yes.
We do.
Okay.
We do every day.
Okay. Does the Bureau have the power to conduct direct examination of financial institutions?
We do.
Okay. Does the Bureau have a whistleblower program for employees to blow whistles on misconduct of their companies?
We have a hotline where whistleblowers can give us information if they see fit.
Okay. So you're still telling me that the powers that you have aren't sufficient for you to uncover and investigate actual problems in the marketplace? Even with all of those tools, you still have to go in and not allow people to know that you're collecting their data in order to make these.
So you're saying we
assessments?
could collect it through examinations and supervision. Instead, we've collected it in the same way other agencies have. How does that
No,
differ?
what I'm
How's that
saying is
different?
one way is somebody complaining to you that something's happening, and the other way is you actually extracting data without the consumer knowing that you're extracting data.
So
what I asked you at the beginning is what provisions that you've put in place to let Americans know when their data is actually being extracted when it's being mined.
We're having a public hearing here that's wide open to the entire American public.
Thank goodness
and
for
you're
Congress
saying
that
you're
is looking
collecting
out
the
for the
data, and I'm
American
saying,
people,
yes, I am.
not the
So-
Consumer Finance Bureau. First of all, I want you to know that the Consumer Finance Bureau, I've been very, very fair in looking at what you actually do. And let me just say that you are always under the guise that you're protecting those who can't protect themselves.
That's
You're
our
always
job.
under the guise, you're trying to let people know that you're the compassionate institution. And let me just say that you can't be the compassionate institution because everything you do is through force, and that is through jail time and fines. If people do not comply with you, it is through jail time and fines. And I want you to know that these businesses that you go after are the ones that gave my father a job when he came to this country with just $10 in his
How does that make us different from the Utah Attorney General?
Okay, so
How
here's
does it
the
make
funny
us
thing.
different from the
So
U.S.
you're saying
Attorney
because
General?
everybody else does it that we're going to
No,
do
no,
it
it's just,
also.
it's in law enforcement.
And
Do you
this
not
is
want the law to
why-
be enforced?
And
Of
this
course
is
you want
why
the law to be
Washington
enforced.
is the problem. This is why you're the problem, sir.
You want people to not abide by the law?
Time of the
That's not the right
gentlelady has
answer.
expired. I'd like to thank the witness for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. I would ask the witness to respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.